Becoming a millionaire or retiring a millionaire isn't as unheard of or out of reach as it used to be in the past. I mean, 1,700 people in America become a millionaire every single day. That means 70 people are becoming new millionaires in the United States every hour. So by the time this video is done, we're gonna have a new handful of millionaires. If you went out and you asked the majority of people, how do most people become millionaires? They'll tell you that it's because of rich parents, or being gifted, or having a trust fund, or winning the lottery, or getting really lucky. You need to have one of these 5 things if you want to become a millionaire. But that's just not true. 88% of millionaires were self-made. These are people that created their wealth and their money themselves, that did not have everything gifted to them. Yeah, you had 12% of millionaires that had rich parents or had money given to them or had all these privileges, but the vast majority of millionaires created their wealth themselves. So if you want to understand how to become a millionaire yourself, you got to understand what these people did. Out of the people that became self-made millionaires, there are 3 general categories or ways that people became millionaires. The first is start a very successful business. Number 2 is earn a very high salary. Or third, invest a little bit of your money every time you get paid. Look, some of the most successful people in the world are people that start and build their own businesses. But the reality is, building a business is not easy, and it is not for everybody. It looks cool and it looks attractive because entrepreneurship is fun, but it is hard work, and you do not get weekends off, you do not get evenings off. Building a business is hard, and it's not for everybody. And so that is not the path to becoming a millionaire for the majority of people. And if we look at trying to earn a super high salary, like people earning $200,000, $300,000, $400,000, $600,000 a year or more, that's not really accessible for most people either, because maybe you're gonna need a special degree, maybe you gotta go out and become a doctor, or maybe you gotta go and become a CEO of a big company. But yeah, that's possible for some people, but not everybody. So I guess both of these 2 options are out for most people. But the third option, investing a little bit of money every time you get paid, is actually how most people become millionaires. It's a slow and gradual process where every time you get paid, regardless of how much money you're getting paid, you put aside a little bit of money and you keep slowly investing it, and you let this money that you're investing grow and compound. And as this money is growing and compound, you keep fueling the fire, because every time you get paid, you're just putting more and more money into this ball that's growing and building you wealth. That way you can become a millionaire in your lifetime by letting your money go out and work. I'm going to show you a few different ways that you can do that. But before I get into that, I need you to do me a quick favor and smash the thumbs up button below. Let's go over some quick numbers. Let's start by going over something that most people should be able to do. Let's assume that you can put aside $10 a day, which is right around $300 a month. If you take this $10 a day, $300 a month, and you keep investing it every single month, I'll talk about where and how to invest it in just a little bit, but let's assume that you can get a 7% annual return on your money on average. So this is a below average return, okay, something conservative. But if you keep investing this $300 a month over the next 45 years, so if you do this from 21 to 66, the $300 a month is going to grow to $1.1 million on the side. Now, if you're saying that you don't got $10 a day or $300 a month, yet you also have a $300 a month car payment or more, then you might want to rethink where and how you're spending your money. If you want to be a little bit more aggressive, and now you can put aside $20 a day or $600 a month, and you can get the same 7% return, which is below average, below the historical average, then you will be able to grow this money to $2.2 million over a lifetime on the side. And let's have some fun. What if you could be even more aggressive and you could put aside $100 a day, which is right around, let's say, $3,000 a month. If you can do that and you can maintain the same below average return, then over your lifetime, you will be able to grow your money to $11 million on the side. Now, while this all sounds good in theory, it's still theory, because now the question is, how do you actually make it happen? Because me sitting here saying that if you put $300 a month into your investments, that you would have grown it to $1.1 million is kind of like the people who say things like, if you invested 45 cents in Tesla or Bitcoin, then the 45-cent investment would have been worth $4.4 million today. So you are very not smart for not making that 44-cent investment 20 years ago. It's impossible to predict what is going to happen. So the question is, what do you do today to actually build these millions in your lifetime? How do you do this practically, and how do you make it happen? Well, the first part of making it happen is you got to work on this side of the equation. How do you get this extra cash? How do you find this extra cash every single month? And there's 2 things you got to do on the mental side of how do you actually get this cash. The first thing you gotta do is you gotta stop living in your feelings. We live in a culture where people live in their feelings, where when people want something, they want it now. And when you want it now, you're gonna do whatever it takes to get it. And when I say do whatever it takes, I don't mean put in the hustle and get the cash to actually be able to afford it. I mean do whatever it takes, like put it on your credit card or finance it or pay it off in installments. If the way your mind works is I just made $1,000, so how can I spend this $1,000? I can go on this vacation, I can buy these shoes, I can go out to eat here. You will never have a chance to achieve this. It's not possible. Okay, because the first thing you got to do is you got to break out of your feelings and understand that now anytime you get paid does not mean that you got to go out and spend this money. Anytime you get paid means now you have more money to invest because you got to put some money aside towards your investments. So the first thing you got to do is you got to stop living in your feelings, and then you got to stop spending all your money. You got to figure out what the right investment amount is for you. I recommend 15% of your income. So anytime you make $1, 15 cents should go towards your investments, but I'm just a random guy on YouTube. You got to make your own decisions. The second thing you do after you start putting some extra money aside is now you got to start growing the pot. You got to start earning more money. The thing that bugs me about traditional financial planners and traditional financial planning is that traditional financial planning focuses just on pinching pennies. But the thing that you got to understand is that at the end of the day, a penny saved is just a penny. Yes, you should not be blowing all your money. Yes, you should not spend your money as soon as you get it. Yes, you got to be smart with your money. But I also want you to work to grow the pie instead of just working to figure out how can you squeeze some extra pennies, because at the end of the day, there's a limit to how little you can spend. But there's no limit to how much you can earn. So once you understand how to spend your money, once you understand how to live below your means, once you understand how to build a system where anytime you get paid, 15% of your paycheck is automatically going to get invested, the next thing you got to do is worry about how can I grow the pie? How can I make the pie bigger? Because if you're making $40,000 a year and you're investing 15%, that's good. But if you're making $400,000 a year and now you're investing 15%, that's even better. Again, going back to the beginning of this video, most people are not going to be able to start their own business, and most people are not going to earn a doctor's salary. But what you can do is you can supplement your income. If you're not happy with how much money you're earning, maybe you can earn a second job. Maybe you can ask for a raise. Maybe you can get a promotion. Maybe you can start a side hustle or do something to earn some extra cash. There are a lot of ways that you can supplement the income that you're getting right now. That way you have more money to grow this pot. That way you have more money going towards your investments. So the first thing you got to do if you want to get this is you got to work on this. That means you got to stop living in your feelings and you got to find a way to earn some more money. That way you have this cash to grow. Once you got this cash right here, the next thing you got to figure out is how do you make this interest, this return on your money? What do you do with this extra cash that you're investing? By the way, if you're interested in learning more about my 15% rule and how to build a financial system that works to build you wealth, to build your savings, that way you understand how to use your money, I already made a video on YouTube where I explained how all of that works. So if you want to watch that video, I will link it for you in the description below. But let's talk about how to actually invest your money now. The whole idea of investing is you want to create this machine that is printing you money without you physically having to work. But in order to create this machine, you got to invest one of two things. Either you got to invest your time or you got to invest your money. Now, for a lot of people, either you're not going to have the time or you're not going to want to put in the time to do it. So I'm going to focus in on the passive investments, because a passive investment is where all you're doing is you're taking some of your cash and you're putting it towards creating this machine that is printing you money without you physically having to go to work, because you're going to work to get paid. Now, you're getting this paycheck and you're going to take a piece of that paycheck and you're going to put it towards buying this machine that's going to print you money. Now, it's not an actual money printing machine because you can go to jail for that, but it's a kind of a theoretical machine that's going to print you money through your investments. The whole idea behind making money is the more value that you can provide to the marketplace, the more money you're going to make. That's why doctors earn more money than cashiers, because doctors provide more value to the marketplace than cashiers do. Now, this doesn't mean that your life is not valuable or that you're not a valuable person as a cashier. This just means in the economic marketplace, a doctor provides more financial value, so they attract more money than a cashier does. So now when it comes to your investments, the whole idea here is you want to put your money in a place that is going to create value or attract value. So you want to use your money as a tool to kind of create this value thing. That way it can continue to pay you without you having to physically work to continually build value. So maybe there's other people involved, or there's a team involved where this machine is now working to build value and create value for you because you have put your money towards it and your time is out doing something else. The most accessible way to do that is by putting your money in the stock market, because the stock market is a place where you can go out and invest in big companies. So Amazon, McDonald's, Facebook, these companies trade on the stock market. So when you go out and you buy shares in a company like Amazon or McDonald's, McDonald's, you become one of the owners of Amazon or McDonald's. Now, you don't get to tell Amazon and McDonald's how to run the company, and you don't got to go to work for Amazon or McDonald's, but when these companies make more money, so do you. Maybe your stock price will go up because if you buy a stock for $100 a share and it goes up to $200 a share and you sell it, you just made $100. The second way you can make money is through dividends. When a company like McDonald's has a whole bunch of cash in their bank account at the end of the year, they can take some of this cash and just give it away to the shareholders, people like you, investors, through dividends. And so these dividends are literally just cash payments that you get every 3 months, every quarter for doing nothing except owning the right company. Between 1926 and 2018, the average return for the S&P 500, which is an index in the stock market, which all it means is it's a group that represents the top 500 companies in the stock market. This S&P 500 over those years grew by an average of 10 to 11% a year on average. This doesn't mean that every single year the stock market is going to go up by 10 to 11%. That means over the long run, the stock market has grown by 10 to 11% a year for almost the last 100 years. But this also includes the fact that sometimes you're going to have stock market crashes and other times you're going to have stock market rallies. Over the long run, you've seen the stock market grow by around 10% a year for the last century. So if the stock market continues to grow at its previous rates and you can just invest your money and even get a below average return, then retiring a millionaire is no problem because you can just throw your money into the stock market and hopefully get the same returns and boom, there you have it, the millionaire status. Except there's a couple issues with that. The first issue is many people do not believe that the stock market is going to continue to grow at the same rate that we saw happen over the last century because our economy is a whole lot bigger, so it's not as easy for our economy to grow as fast as it once did, which is why we might not see the same returns in the stock market over the next century. The second issue is you got to know how to actually invest your money in the market, because if you just take your money and you randomly put it in some stocks, then that doesn't mean you're going to meet the stock market return, right? Because the S&P 500 is an average of 500 companies in the stock market. It's not the entire stock market. During the last century, you had a lot of stocks go bankrupt and go bust. And so if you invest in a company that goes bankrupt or bust, then you lose your money and you won't get these returns even though the stock market went up because the company you invested in went down. So now, given these circumstances, how can you still get a good return in the stock market if our economy isn't growing as fast as it once used to? And how do you invest your money in the stock market without worrying about the company you invested in going bankrupt? Let's start with this. When it comes to investing, you got to first understand the correlation between risk and return, because in general, you can get a better return if you're willing to take on higher risk. And so if the general stock market sees lower returns in the future, you can still try to get higher returns, but that might mean you have to take on higher risk. Now, one of the ways that you can mitigate risk, meaning lower the risk, is by having the right education and understanding what you're doing, because if you have more knowledge, then you can kind of lower some of this risk. But you got to understand, yes, you can still get higher returns, but you got to understand how to kind of manage this risk too. So the S&P 500 index, the one that I just talked about a minute ago, that was averaging 10 to 11% returns a year, the S&P 500 is a group of the 500 largest and most established companies in the stock market. And so when a company is large and established, it's not going to be able to grow as fast. And so if you want to get better returns, then you're going to have to invest in a company that's a little bit more innovative, that's trying to grow, because now these companies have more room to grow, because when a company is already large and it controls the entire market and it doesn't have that much more room to grow, it can't grow as fast. Versus a company that's smaller and trying to innovate and grow, there's a whole lot of room for opportunity, and so they can see much better returns. So if you're trying to get better returns, then you can't be making the same investment decisions that people were making 30, 40, 50 years ago, because back then in the 70s, if you wanted to invest your money, all you had to do was invest your money in the general stock market, and you knew the United States economy was booming, and you knew the United States economy had a lot of room to grow, and so these big established companies still had so much room for opportunity and growth, which allowed these easy general stock market funds to grow and boom, which allowed people to grow their money and compound their money very quickly. You might not have that same opportunity today just because our economy is so big and these companies are so big, they don't have the same room for growth as they once did, or at least that's what people think. And so if you want to continue to get that same growth, you got to be a little bit more innovative. That means instead of just investing in your traditional large blue chip companies and these funds that give you exposure to the general stock market, maybe you got to start looking at innovative companies or value companies or growth companies, because these are smaller companies that are kind of like more of your startups that have a lot of room for growth. Now, obviously, there's more risk here because if you're investing in a startup, there's a chance that this company will fail. But if you want to continue to get those higher returns, you got to start educating yourself here. That way you can make smarter decisions. That way you can get the better returns. Does it come with more risk? Yes, because you are never guaranteed to make money when you invest. You might even lose money. So make sure you always do your own due diligence and never blindly listen to a random guy on YouTube. Now, when it comes to actually investing your money and putting your money to work, there's a couple different ways that you can invest your money in the stock market. The first way is you can find individual companies to invest in. So you can go out and invest in individual companies like McDonald's or Tesla or Facebook or whatever. But when you invest your money in these companies, you take on all the risk. Because if you invest your money in McDonald's and the McDonald's executives run the company into the ground and the company goes bankrupt, now your investment account is bust. So one of the things that you can do to protect yourself, especially if you're not planning on becoming a full-time investor, or if you don't plan on spending at least a few hours a week researching your investments, then one of the things that you can do instead of investing in individual companies is just invest in ETFs. An ETF is a fund that gives you exposure to a whole bunch of companies. That way now you don't got to worry about trying to be in the stock picking game, because you can invest in a fund that gives you exposure to a whole bunch of different companies. You can buy and sell shares of an ETF the exact same way you do stocks. The only difference between an ETF and a stock is when you invest your money in a stock, you get exposure to one company, but when you invest your money into an ETF, you get exposure to a whole group of companies. So kind of like what I talked about before. If you just wanted to get general exposure to the stock market, then you could invest in an ETF like VOO or SPY. Both of these ETFs give you exposure to the S&P 500, and both of these ETFs give you exposure to the top 500 companies in the stock market. Now, again, this goes back to the concern like we just talked about. Yes, this will give you exposure to the top 500 companies, but we just don't know if the stock market and our economy is going to be able to grow at the same rate that we saw happen over the last century. Maybe it will, maybe it won't. But the thing that you have to understand about these is these typically come with less risk, because if the economy continues to grow, then chances are our big companies are going to continue to grow, which means chances are these funds are going to continue to grow. So less risk and less potential return, however, is more of a safer investment over the long term. Yes, you might see market crashes, which makes it kind of risky in the short term, but over the long term, if you believe in the United States economy, then these are generally kind of your safer investments. If you're looking for more value type investments where you can hopefully try to see bigger returns but also come with more risk, then you can look at investing in funds like ARKK, this is ARK, and QQQ. Again, these are just examples. Make sure you do your own due diligence, and as a quick disclaimer, I do have some of my own money in VOO and ARK. So these are a couple examples of ETFs that are trying to invest in more of your value companies, more of your innovative companies. That way you can hopefully see bigger returns over the long term. But again, it comes with more risk, so you got to do your own due diligence and understand how to balance it out. The key for this type of stock market investing to work is you got to understand that this is not a one-time investment that you're going to make. This is something that you got to keep consistently investing. Like I talked about that 15% rule earlier, where anytime you get paid, a portion of your paycheck is going to go directly to your investments. That way you're consistently investing a little bit of money. That way your investments can compound here. Your money keeps growing here, and you keep adding fuel to the fire, because anytime you get paid, you're adding more money to the fire. You're adding more money to this machine that is working to make you more money. Before I move on to the next way that you can invest your money, if you do want to learn more about how to do this and how to create a passive system that where your money can automatically be invested and how to find a brokerage that can do this for you for free, our team broke down how to do this on our website, theminoritymindset.com, and you can read that article by clicking the link in the description below. The second way that you can invest your money, which is actually my favorite way to invest my money, is by investing your money in real estate. The way real estate investing works is you can go out and you can buy a property like a house, and when you buy this property, so let's say this is me, I'm going to go out and I'm going to buy this property. Got to draw me a nice mustache. I go out and buy this property, and then I'm going to rent this property out to somebody else. I'm not going to live here. I'm going to let this person come here, or their family. They're going to live in this property. They're going to use my house. They're going to live there. And in exchange for them living in my property, every single month, they're going to send me a $1,000 check, because that is their rent payment. And now out of this $1,000, I'm going to use this to pay my taxes, my insurance, my maintenance, my management fees, my vacancy costs. And then if I have any debt on the property, it's also going to pay some debt. And if I do this the right way, I'm going to have some money left over every single month. And these profits go into my pocket. for my investment. The thing that really differentiates real estate investing like this and investing in stocks like I talked about before is when I invest my money in real estate, I am looking for passive income. I am looking for cash flow. The most important thing here is not how much I think this property is going to be worth in 5 years or 10 years. In the stock market, that's what a lot of people are looking for. They're looking for companies that are going to be worth a whole lot more. That way they can sell their stock for a big profit. Here, I'm not really interested in that. The most important thing here is this cash flow. How much money do I gotta invest today and how much money am I gonna make every single month? So it's a different investment strategy because here, my goal is that passive income, it's that cash flow. And my investment goal is on a low end, 7%, but typically I'm looking for an 8% annual return on my money. So if I invest $100 today, I want to get $8 back next year and the year after that and on and on and on. So these are the type of returns that I'm looking for when I invest my money in real estate, and this is in the form of passive income or cash flow. The thing that makes real estate a little bit more difficult is in the beginning, while this is called passive income, it's really not passive, especially in the beginning, because you got to jump over this hurdle to understand how real estate investing works, and you got to find the team. I mean, you got to find your real estate agents, your property managers, your contractors, you got to work with city officials, and so if you don't know how any of that works, it's going to be a big time commitment, and you need a lot of capital. Like this property might cost you $100,000, so you're going to need either a lot of cash, you're going to go out to the bank and you got to borrow some money, versus if you're investing your money in the stock market, you can start with $100 and it only takes like 5 minutes. Here, buying a property can take you months. You have this element of non-passiveness because you got to find the deals, you're going to renovate them, you got to get them leased out. But once you get the hang of things and once you get this property ready to go, you can hand over the keys to a property management company and then it can be fully passive if you know how to do it. And so it takes that hurdle to jump over, but once you jump over that, then it can be completely passive. Now again, the key here to succeed over the long term is to keep compounding your money. That means when you have this money growing in this real estate property, you got this passive income coming in, you can do a couple things with it. You can use this money to go out and go on a nice vacation, or you can reinvest this money to go out and buy a new property. So that means over the years, you're gonna save up some more cash to buy another property, and then you're gonna use this cash to buy you more properties as well. So this cash should help you, fuel you to buy more properties quicker. That way you can increase the amount of cash flow and passive income you have. So it's kind of this compound interest game, where it's how fast can you accumulate these properties and how fast can you grow this passive income. But now, once you understand all the things that I talked about, first you gotta understand the mental game, where you gotta stop living in your feelings and you gotta stop spending all your money. And then you gotta work on how to grow the pie. How can you attract more money that we have more money to invest? Then it's all about investing your money and you got to know your goals. Now you got to invest your money into places where you're going to grow your money. And now it's just a math question. Where can you invest your money? What type of returns can you expect? And how long is it going to take you to hit that $1 million based off of how much money you're investing? Once you understand the whole system, then it's just a numbers game where you got to just keep following the system and you got to just keep pumping your money into your investments. That way you can build this nest egg that's growing to make you wealthier. We're going to jump back into the video in just a second. But before we do, here are a few words from our sponsor, Fundrise. But before I give you this advertisement, I do have to give you a disclaimer, which is that I do have some of my own personal money invested in Fundrise, and I also own some equity in the Fundrise company as well. If you've been thinking about investing in real estate, but you don't want to deal with the headache of property ownership, Fundrise makes it easy for anybody to get exposure to real estate investments with as little as $10. And now you don't have to worry about going out and buying a property yourself. You don't have to worry about managing tenants, and you don't have to worry about unclogging toilets. The way it works is you invest your money into Fundrise and you're getting exposure to a portfolio of real estate properties. And then you will get paid your share of appreciation and cash flow if your fund makes money. Remember, this is investing at the end of the day. Investing has risks. You are never guaranteed to make money when you invest. In fact, you will probably lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. The nice thing about Fundrise though is now you can passively invest your money into real estate without having to deal with all the headache of property ownership. Second, Fundrise has an auto invest feature. That way, if you want to continually invest more money into real estate, you can do that through Fundrise. And third, they have a very cool dashboard that you can use to track the progress of your investments. Now, the last thing that I want to remind you is that when you invest your money in Fundrise or real estate in general, your money is not as liquid as it is when you invest your money into the stock market. So you have to remember, if you're going to invest your money in real estate, whether it's to buy an individual property or to invest your money into a fund through Fundrise, you are investing your money for the long term because you're investing your money in real estate. So if you want to learn more and see how you can start investing with Fundrise, I got the link to how you can do that down in the description below. Minority Mindset is a paid partner with Fundrise, meaning if you use them, we will get compensated, but there's no additional cost to you. So if you want to learn more and see how you can start investing in real estate through Fundrise, I got the link to how you can do that down in the description below, where you can go to theminoritymindset.com/Fundrise. That's theminoritymindset.com/Fundrise. And with that, we'll go back to the show. If you are not a millionaire yet, then this video was made for you to watch and learn from. That way you can build a plan for yourself. That way you can actually achieve the financial dreams that you have. That way you can take better care of yourself, you can take better care of your family, and you can take better care of your community. Growing up, I always wanted to have money. But in my culture, that was almost taboo. And my parents always told me, don't talk about money, don't worry about money, and don't think about money. But at the same time, I would see my parents go to work every single day and work their butts off with very little vacation. If my dad had a Saturday and a Sunday off, that was considered a long weekend. So I saw them always talk about how money's not important, but at the same time, I saw how hard that they worked. And so I wanted to change things up. I said, well, if we have money, then you won't have to work as hard. That's when I started to go on my financial education journey to learn how I could have some money. That way we could have more financial freedom. Now, I was very fortunate. I was never poor. I never had to worry about my next meal. I was never worried about being broke or anything like that. But I wanted to give back to my parents. That was the initial thing that drove me down this financial education journey. And then as I started to see more success, as I started to make more money, then it became a different goal, more of a purpose. More of a, wow, we are never taught about money. How come we're never taught about money? I can't believe that I went through all this schooling. I went through college. I went through a year of graduate school. I then went through law school. I did everything right. But I never once learned a thing about money. And most of us go through this system. We go through doing everything right. We check all the boxes, but we never ask, whose boxes are we checking? Because if you want to become financially successful, because we all go to school to get a job so we can become financially successful, well, the thing you have to understand is just because you have a good job or you have a good degree or you have a good profession doesn't mean that you're going to be financially successful. In fact, they're two completely different things. Financial success is about your financial education. This isn't something that you get in school. Your career success is what job you have or what career you have. That's completely separate. You can be rich, but hate your career. You can have a good career, but not be rich. Now, if you want to be financially successful, which is what I'm going to be talking about here, you have to understand the financial education. And there are 6 steps that you have to take in this order if you want to be financially successful yourself. And number 1 is understanding that you have to build that growth and wealth mindset. And this might seem kind of like, Jaspreet, what are you talking about? What does mindset have to do with becoming financially successful? Well, I can tell you this. If you do not have the right mindset, if you tell yourself that I can't be rich, if you tell yourself I cannot become successful, if you tell yourself that somebody who looks like me can't do it, if you tell yourself that somebody who has the upbringing that I had can't do it, you're right. I guarantee it. You will never be able to see the success that you want because you told yourself that you don't. But if you change the way you think, if you believe that you can become successful, if you believe that you can do it, well, now nothing can stop you. Growing up, I was told time and time and time and time again, there's somebody who looks like me. There's somebody who knows nothing about business because no one in my family is a business person. No one in my family is an investor. No one in my family is one of these types of people. That nobody like me should be able to go out and do it. In fact, I should just study and become a doctor because that's what a good person from India, a good Indian family, a good Indian kid, a good person like me should do. But I decided to do something different. I was the dumb one who decided to do something different. And during the decade of me trying to figure it out, I looked like the dumb one. But then once I figured it out and I started to see more success, then everybody kept asking me, how did I do it? How do I achieve more success with money? How do you invest your money? How do you do all these things and do the things that you have now? Well, you can't ignore all the 10 years that I had to go through to get there. So the first thing is you have to believe that you can do it. The way I put it is you got to be willing to be stupid. Because if it wasn't for me being stupid, I wouldn't be here talking about this. Money is just a tool. It amplifies who you are. If you give a good person money, they have a tool to do more good. If you give a bad person money, they have a tool to do more bad. That's why we need more good people with money. Money is just fuel. It amplifies you. It doesn't change who you are. If you have bad intentions, more money is going to amplify your bad intentions. This is why I keep saying that money is really emotionless. Money is not a good thing or a bad thing. It's just paper.
It just is. It allows you to do more of the things that you want. More money isn't going to make you happy after a certain point. Yeah, if you're broke, if you don't have any money, more money will definitely make you happy. But more money is not going to change the anxiety or the depression that you have if it's something deep-rooted within you. This is where you have to understand how money plays a part in your life. More money isn't going to fix the relationships that you have with your parents or with your spouse. You have to understand that these are all different things. Money has its own place. More money will fix more financial problems. It will allow you to buy more things that you like. But you have to also understand how money plays a part in your life. Because if you don't have money and you keep putting up these smoke screens saying money is bad and money is taboo and money is evil, well, now you're the one that's stressing to pay your bills. You're the one that can't afford to go on a vacation. You're the one that can't give their spouse the vacation that they want. You're the one that can't give their kids the education that they should get. And you're the one that can't afford to take better care of your parents. This is why it's important for you to actually go out and get the money. Once you understand step number 1, which is the mindset, then you can move on to step number 2, which is knowing how to save your money strategically. If you have no savings, like the majority of Americans do, the very first thing that you need to do is you got to save $2,000 as fast as humanly possible. If you do not have $2,000 saved up right now, you are in a financial danger zone, because if something goes wrong, if your car breaks down, if your AC breaks, if your heater breaks, if your window breaks, if something goes wrong, well, now you're going to have to go into debt to fix that problem. And now you're going to have to dig an even bigger hole to dig yourself out of the problem. You need to save $2,000 as fast as humanly possible. Cut back on your expenses, work to earn more money and sell some things. Do whatever you got to do to save $2,000. Put it in a checking account, put it in a savings account. Just put it in an account that you don't touch unless it's an absolute emergency. This is the beginning of your emergency savings fund. Once you save the $2,000, the next thing that you got to do, which is a part of this step, is you got to understand the power of compound interest. Because let's assume now that you start by investing $8,900 the day you turn 21. Somebody gives you $8,900 and you invest this money and you can get a guaranteed 20% return on your money year over year. And you do this for about 40 years, which is, the course of your career. Well, if you do that and you never invest another penny after you invest this $8,900, well, you are going to retire a millionaire. Not just a millionaire, you're going to retire a multi-millionaire with over $13 million in your bank account. If you can maintain these types of returns and you never invest another penny again after you invest this $8,900 when you turn 20 or 21. Now you might be thinking, but Jaspreet, where in the world am I going to get a guaranteed 20% return on my money year after year after year? Well, let me show you somebody who's doing it right now. Your credit card company. If you carry any credit card debt, you are the one that is making your credit card company richer year after year after year. So the second half of laying your foundation is first building a little bit of a savings cushion, but then digging yourself out of this financial grave, because credit card debt is skinning you alive. If you have any sort of this type of high interest credit card debt, you got to pay it off as soon as possible. Don't worry about investing your money in the stock market. Don't worry about putting your money somewhere else. You need to pay this debt down as fast as humanly possible. The average stock market return is 7 to 10% a year. Why are you trying to invest your money in the stock market and get a 7 to 10% return a year when you could get a 15 to 25% return by paying down your credit card debt? Step number 3 is you got to start putting your money to work. See, what wealthy people do is they create a system where anytime they earn money, their money has a job. Every dollar that they earn has a specific job. For the majority of people, the way that their finances look is they make money and then they spend money. And then after they spend their money, they wonder where all their money went. What wealthy people do is they make money, and then some of this money is going to be for their spending purchases. Some of this money is going to be invested, and some of this money is going to be saved. But they have a system that tells them every time they get paid how much money is going to be spent. That way they don't overspend. They know how much money is going to be invested. That way anytime they get paid, they're always working to earn more money, and they have some money that's going to be saved. This is the money that's building their financial cushion. When wealthy people run into a financial problem, they don't start panicking. They have their savings to fall back on. And anytime they get paid, what they're working for is to increase their investments, because your investments are things that you buy that work to earn you more money. For the majority of people, the only way that they earn more money is maybe I'll work harder at my job. Maybe I'll get a second job. Maybe I'll get a promotion. But what wealthy people are thinking is, yeah, I could work harder at my job, but there's a limit to how hard I can work. There's a limit to how many hours I can work. There's a limit to how many things that I can do. But there's no limit to how much money my money can make me. This is why wealth people are always working to increase their investments, because when you buy investments, now you're buying more money. You're buying something that's working to earn you more money. This is why wealthy people always prioritize this over this. Wealthy people are prioritizing their investments, their assets over a new car. They're prioritizing their investments over a new vacation. They're prioritizing their investments over a new wardrobe. Sure, you can have all the nice things, but first you got to make yourself rich before you make everybody else rich. Once you have more and more investments, now it's much easier to spend money because, well, you have money coming in from your money investments. Your money that your money made is paying for this. It's not the money that you're working to earn. When your money that your money made is paying for your lifestyle, now you are financially free. This is why wealthy people always prioritize this versus broke people, and the majority of people are prioritizing their spending. Broke people are prioritizing looking rich, while wealthy people are prioritizing actually becoming rich. Now, ironically, if you want to actually become rich, you've got to sacrifice looking rich right now. I call it the decade of sacrifice. But if you're willing to put in that work, well, now you'll be able to afford all the nice things that you want, and you won't have to worry about the price. Now, to build a system like this, you can create whatever numbers you like. For a simple rule of thumb, something that you might want to start with is something like a 75, 15, 10 plan, which says now for every dollar that you earn, the maximum that you can spend is 75 cents. The minimum that you invest is 15 cents, and the minimum that you save is 10 cents. Now, how do you invest your money? Well, this could be investing money in your own education. This could mean investing your money to pay down other debts. This might be your mortgage, this might be your car payment, what other kind of debts that you have outstanding. This could be putting your money into the stock market. This could be putting your money into real estate. This could be putting your own money back into your own business idea. This could be putting your money into a startup idea. There are an unlimited number of ways for you to invest your money, but the whole idea here is you're going to be investing your money, that way you can grow it. Now, for the majority of people who don't want to be active investors, they don't want to be researching companies, they don't want to be going out and looking for real estate deals, they don't want to be working with startups, they just want to passively invest their money and see their money grow. Well, you have that option with the stock market. You can find some ETFs. An ETF is a fund, a group of stocks that you can just passively invest your money in, because what we've seen is that historically, we have seen the stock market grow by 7 to 10% a year. This doesn't mean that the stock market will always grow by 7 to 10% a year. Some years it will be more, some years it will be less. But the stock market in general has grown by 7 to 10% a year for the last century. Well, if you don't want to be actively involved with putting your money into the stock market, how do you do that? Well, you can find a fund that gives you broad exposure to the stock market. Like there's ETFs, funds that give you exposure to the total stock market. There's ETFs that give you exposure to the S&P 500. The S&P 500 are the 500 largest companies on the stock market. You have ETFs that give you exposure to the Dow Jones. The Dow Jones is a group of 30 companies which are in different sectors. There are ETFs that give you exposure to the NASDAQ. There's ETFs that give you exposure to tech companies. There's ETFs that give you exposure to innovation. They give you exposure to emerging markets. They give you exposure to dividend-paying companies. You can figure out what it is that you want to get exposure to. Then you can find either an ETF. An alternative to an ETF would be an index fund. Or you can also potentially look at mutual funds, but sometimes the fees on mutual funds are going to make them much less attractive. ETFs and index funds tend to have much lower fees, which means typically more money in your pocket. But now this allows you to passively invest your money. Now, if you want to be more actively involved, now you can look at investing in individual companies, which is more risky, but you also have more potential upside, because now if you invested in Amazon and Amazon took over the world, well, now you can see much bigger returns. But if you invest in Amazon and Amazon goes bankrupt, you lose everything. So for people who want to be passive, ETFs can be a good way to go. If you want to be more active, you could look at investing in individual companies. Now, you don't have to pick one or the other. You can do both. Like I invest my money passively and actively. You can also look at investing in real estate and a whole bunch of other alternative investments. But the key here is every time you get paid, some of your money has to be going towards your investments. The last thing that I want to say about this is regarding your savings. When it comes to your savings, there will be a limit to how much money you want to save, somewhere between 3 months and a year's worth of expenses. Once you hit that savings goal that you want, well, then you want to take the savings money and then put it right back here into your investments. The more you invest, the more money you're going to be earning, which means the more money you spend, but also the more money you invest. You create a wheel where every time you spin it, you're going to have more money funding that wheel. This is the compound effect. This is what wealthy people are doing. They're always working to own more of these, which is going to pay them with more money. Now, if you are looking for an easy way to stay up to date on what is happening in the financial markets, you can join something like Market Briefs. Market Briefs is my completely free newsletter to keep you up to date on what's happening in the financial markets. We cover things like the stock market, the housing market, the crypto market, the global economy, and our own economy, and we break it down into a fun, witty, and easy to read email. You can read it in less than 5 minutes every morning, and even if you don't have a financial background, not only are you going to understand what's happening in the financial markets, but you're going to look forward to reading Market Briefs every morning. And the best part with Market Briefs isn't that it's brief, it's that it's completely free. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. This brings me to step number 4, which is now understanding your debt. Because most people at this point think, well, I'm paying 4% a year for my mortgage, maybe 6%, maybe 7%, depending on when you got your mortgage, but let's assume 4% for my mortgage. But I can go and invest my money and I can try to get a 8% return on my money. So what should I do? Should I invest my money or work to pay down my debt? And this is going to be a little bit more complex than what you might think, because you might say, well, obviously get the higher returns. Well, the problem is this return isn't guaranteed versus paying down your debt is a guaranteed return. When you pay down your mortgage, you pay down your car payment, you pay down whatever debt that you have, assuming it's consumer debt, you're going to get a guaranteed return on your money. When you invest your money, you have no guarantees. Maybe you get an 8% return. Maybe you get a 15% return. Maybe you get a negative 8% return. You don't know that. So you have additional risk here. This is why if you want to make this decision of investing your money versus paying down your debt, you have to ask yourself now, what's your risk tolerance? What's your investing education level? And what type of lifestyle do you want to live? Because if you come to me and you say, Jaspreet, I want to live big. I want to have it all. I want to be really rich. I want to have a lot of money so I can do whatever I want whenever I want. Well, then you can't be playing small and trying to get this 4% return just to pay down your debt. You got to be working to get bigger, better returns. Now, obviously, you don't want to be foolish with your risk, but you have to take on more risk if you want to see the bigger returns. If you say, Jaspreet, I just want to live financially free. I don't want to have to ever worry about money again. I don't care about having all the big, flashy, nice things. I just want to be comfortable and be stress-free and never have to worry about money. Well, in that case, yeah, work to pay down the debt, because when you have no expenses, now every dollar that you earn can be invested, and it's much easier because now you have no expenses. When you have no expenses, you can live much more free. And this is where now the first thing is understanding what debts you want to pay down, what debts you want to keep. But then secondly, not taking on more debts, not doing the things that got you where you are right now. So not going out and financing things that you don't need, that you can't afford, that aren't paying you. If you're going out and spending other people's money to buy this, well, now you're going to spend the rest of your life paying it off. Use your money to make yourself richer, not your banker richer. But that also applies to something called 0% APR. And this can make a lot of people upset because people think, wait, Jaspreet, 0% APR, that means 0% interest. If I can borrow money for free, why don't I just go and invest the money and then buy the thing that I want? Like if I can go out and buy this $1,000 phone right now at 0% APR, that means I could take this $1,000, go out and buy an investment and try to get a return on my money and then only pay $50 a month to buy this. And in theory, it makes sense. The problem is, well, why are banks and businesses so excited about selling this idea of 0% APR? I mean, the most expensive kind of money is free money. And if they're giving you money for free, they got to be making money somewhere, right? Well, yeah. There's a reason why 0% APR is so profitable for companies and is so profitable for banks. Not because they're not charging you any money, because they know that if they can get you hooked on the 0% APR, they can, one, get you to buy more things, and then second, if you don't pay off your debt in time because you bought so many more things, which happens to so many people, now you're going to be on the hook paying 10, 15, 20, or 25% a year in interest. If you just take the cash and go out and buy this thing, you're going to have more financial pain today. But if you go through that financial pain today, you're not going to go and spend money on things that you don't need and that you can't afford. But if you don't go through that financial pain, well, now you're much more likely to spend money on things that you don't need and that you can't afford. Step number 5 is earning more money. Most people try to start here. They think, I have financial problems, so I gotta earn more money. The problem is, if you don't know how to live below your means, if you don't know how to build a financial system, if you don't know how to manage your debt, earning more money is gonna make your financial problems even worse, because now you're gonna have more money to finance things that you can't afford. You're gonna have more money to live your lifestyle where you're spending money the wrong way, and now your financial problems become worse. That's why for so many people, what you see happen is people work hard to earn more money, and then boop, their expenses magically rose with their income. So this is where now you want to know how to live below your means before you start earning more money. And when it comes to earning more money, the thing that I like to say is, look, this is your income. Let's say you're making $45,000 a year, right? And most people assume that, okay, this is how much money I am investing for my future. And then you start to like this financial education game. And now you say, you know what? I'm going to try to squeeze more pennies out of my pie. I'm going to try to invest more. I'm going to live smaller. I'm going to do more things so I have more money to invest so I can build more wealth. And you try to just keep squeezing more and more pennies out. But what I want you to start thinking now is not how I can just squeeze more pennies out of my pie, but now how can I take this pie and make it bigger? How can I go from $45,000 a year to $450,000 a year? Because now when you take the same slice out of this pie, now we're talking about way more dollars. You might be going from $10,000 a year that you're putting aside towards your investments and your savings to $100,000 a year. It's the same ratio, but the difference is this is way more dollars. Now at first, when you hear this, you might say, but Jaspreet, how in the world am I going to go from $45,000 a year to $450,000 a year? Well, this goes back to the first thing that we talked about, which is your mindset. First, believing that it's possible, because if you believe it's possible, now you're going to start reading books. You're going to start watching YouTube videos, and then you're going to start trying things. You have to be willing to try things. You're going to work to create your own income, because in this day and age, it is more accessible than ever to create your income. And in this country, you have the freedoms to do that. Now you can try to create your own income. Try to create your own business. Try to create your own product and try to sell it. Now, if you're not an entrepreneur and you say, you know what, Jaspreet, I don't want to build a business. I don't want to build a side hustle. That's not for me. It's too risky. Fine. But now you can look for other ways to earn more money. Maybe you work a second job. Maybe you get a certificate. Maybe you switch careers. Maybe you switch jobs. You switch companies. You got to figure out now, how can you earn more money? But the key here is when you start earning more money, it's what are you doing with this additional money? Are you going to take this money and blow it on a new car and a vacation? Or are you going to take this money and flow it through your system? That way you have more money to invest. The simplest way to become wealthier sooner is when you inflate your income, you don't immediately inflate your lifestyle. Inflate your lifestyle slower than you increase your income, and you're going to see your wealth skyrocket, because you're going to have more and more money going towards your investments, and the more money you invest, the wealthier you will become. And this brings me to step number 6, which I like to call be great, where now you finally start to achieve the wealth that you dream of. Now, how can you be great? How can you be great for yourself? How can you be great for your family? And how can you be great for your community? Because the reality is when you have more money, well, you can also do more. It costs money to eat, and it costs money to feed other people. Well, when you have more money, not only can you take better care of yourself, but you can also take better care of your community. So you can give more. But in addition to that, you also want to make sure that you protect your pockets. Because when people realize that you have money, or even when people think that you have money, they're going to try to take their hands, put it in your pockets, and take some of your money for them. So you want to make sure you shield your pockets. This is where you got to make sure you have a good attorney on your side. You want to make sure you have a good accountant on your side. And you want to make sure that you have good insurances on your side, because people will try to come after you. And you got to put up these protections, that way you can take care of yourself, you can take care of your family, and so you can keep taking care of your community. I am a licensed attorney, so I can tell you from my education that America is the most litigious country in the world, and anybody can sue anybody for anything. And then I've also been sued. My real estate company has been sued because we had a tenant claim that they slipped and fell in the bathtub because they said that the bathtub was too slippery when the water was on. And then we later found out that they didn't slip and fall in the bathtub. They slipped and fell at a friend's barbecue, but they were trying to take money from their landlord. These things happen, so you want to make sure you have a good attorney on your side. You want to make sure you have good insurances on your side. And if you are looking for a good attorney, I also have a legal referral business where I can help refer you to a good attorney, whether it's an IP attorney, a patent attorney, a copyright attorney, a business attorney, a real estate attorney, a bankruptcy attorney, whatever it might be. If you're looking for a good attorney and you want me to refer you, I have the link to how you can do that down in the description below. But this is where you want to make sure that you're taking care of yourself, because the reality is people will try to take some of your wealth for themselves. So you want to make sure you can keep taking care of yourself. So you want to make sure you have the proper shields in place from the right people, the right team. You want to make sure you have the right insurance. You want to make sure you have the right entity structure. And then you have to make sure you have the right estate planning in place. Have a will, have a trust. That way when you die, because everyone will die, you're not going to rely on the government to decide where your money goes. Have the attorney now decide what is going to happen with your money. You don't have to go through my referral. Just find an attorney and take care of this. Spend a few $100s to do that, because the last thing you want is people fighting over your money. Just dictate it and let the world know how you want your money to be divided up after you die, that we don't create family disputes, because I've seen it happen way too many times.
We're going to jump back into the show in just a minute, but first, here's an advertisement from our sponsor, me, with Briefs Media. If you're looking for an easy way to stay up to date on what's happening in the top finance and business news, we make it super easy for you to do that at Briefs Media, because we created a free newsletter called Market Briefs. Market Briefs is a super simple and easy way for you to stay up to date on the top finance and business news. You can read Market Briefs in less than 5 minutes every morning. It's a fun and witty and easy to read newsletter, and I promise, if you join Market Briefs, you are going to love it. Now you might say, Jaspreet, how can you promise that I'm going to love Market Briefs? Well, if you don't love Market Briefs, you can unsubscribe at any time, because it's completely free. So if you have not joined Market Briefs yet and you want to stay up to date on what's happening in the top finance and business news, I got the link to how you can join Market Briefs down in the description below, or you can go to briefs.co/market. That's briefs.co/market. And with that, let's go back to the show.
If you want to save your first $100,000, you don't need to live like you're broke and only eat rice and beans for the rest of your life, but there are 5 things that you need to do when you get paid in this order. That way you can save that $100,000 sooner rather than later. The first thing that I want you to do is to create 3 separate bank accounts. And the reason why I want you to do this is because each one of us have different things that we're good at. Like for example, me, I'm good at how I spend my money. I can control my spending very easily, but I'm not very good at controlling my eating. I like food. When there's food in front of me, I'm going to eat it. So in order to stop me from eating, I don't have the food in front of me, or I'll just eat whatever's there. So I've learned about me that some people are very good at eating, that when they start eating, they can stop themselves before they're full. When I start eating, if there's food there, I will eat it. But when it comes to spending, I'm a much better controlled spender than I am when it comes to eating. So if you want to control your spending, the first thing that I want you to do is create 3 separate bank accounts. One bank account is going to be for your spending money. One bank account is going to be for your investing money. And one bank account is going to be for your saving money. And the reason why you want to do this is so you don't accidentally spend your investment money, or so you don't accidentally spend the money that's supposed to be saved, because now it's out of sight, out of mind. And now what you want to do is anytime you get paid, your money's going to go here. But then as soon as your money goes into this bank account, you want to automatically take some of this money and move it into this bank account, and automatically take some of this money and move it into this bank account. Many banks will automate this process for you for free. If you don't have a bank that allows you to do that, maybe you look for new banks in your area that will allow you to do that. But a lot of banks will allow you to create an automation like this completely free. And now you have a system of knowing this is the money that you can spend. If there's no money in here, you have no money to spend. The second thing that I want you to do is know how much money you can spend versus invest and save. And a simple place to start is something like my 75-15-10 plan, which says that from now on, for every dollar that you earn, 75 cents is the maximum you can spend, 15 cents is the minimum that you invest, and 10 cents is the minimum that you save. Now, if you're watching this saying, but Jaspreet, I'm spending 100% of every dollar that I earn. How am I supposed to now take some money aside and use it to invest or save because I don't have some extra cash? Well, I want you to think of it this way. If the government tomorrow announced that there's going to be a new 25% tax on your income, what are you going to do? You're going to kick, scream, complain, cry, and then you're going to figure out how to pay it. Same thing here. Now what you're doing is you're not giving money to the government, you're giving money to yourself to make yourself rich. Because now what wealthy people do, and what you're going to be doing, is you're going to pay yourself first. And by paying yourself, I don't mean going out and buying a new Gucci bag. I mean now using money to make yourself wealthy. Your investments are here to make you wealthy. Your savings are here to protect you against a financial emergency. This spending money is there to allow you to have the nice things, go on the nice vacations, eat at the nice restaurants, buy the nice cars, but this money is not going to make you rich. This money will make you rich. This money will protect you financially. This money will allow you to live your life. But you need to make sure that now you're not spending all of your money here. That way you always, no matter what, pay yourself first. You're always going to be investing your money because this is where you're going to build your wealth. Now, if your goal is to put aside $100,000, let's talk about what this actually means, because if you're making, let's just say $50,000 a year, and now you're going to be putting aside 25% of your income, some of it's for investments, some of it's for your savings to build your wealth. That means that right now you're going to be putting aside $12,500. At this rate, if you put aside 25% of your income, assuming you don't get a pay raise, because if you get a pay raise, you're going to be investing more money and saving more money, because now when you get a pay raise, your investments also get a pay raise. But if you don't get a pay raise and now you're putting aside 25% of your income, well, it's going to take you 8 years to have that $100,000 put aside. Now, some of this is going to be in your savings account, some of this is going to be in your investment account, but now you have a solid plan on how you can put aside $100,000 in not that long of a time, assuming you don't get a pay raise, but there's more. Number 3, if you want to accelerate how fast you can put aside this $100,000, you can also let your money make you money. Because now when you're putting your money here to invest, this money is supposed to grow. Now, this doesn't mean it's necessarily going to grow by a certain percentage every single year, but you're putting this money aside here. That way it gets bigger. That way your money is making you money here. The money here in your savings account probably isn't going to grow much. Sure, maybe if you put your money in a high interest savings account, you might get some return on your money, but this is where you really want to see your money grow. And if you know how to invest your money the right way, now not only are you putting money aside, but your money is going to be working to grow as well. That way now you're working to get a raise. That way you can give a raise to your investments and you can get a raise to your savings, but then your money that you put into this investment account is also going to be working to grow as well. That way this can grow even quicker, so you can hit this goal even faster than 8 years. The 2 most common places where you can invest your money are into stocks and then into real estate. So let me talk about both and talk about the different ways that you can invest your money and different ways that you can actually get a return on your money. When you invest your money into the stock market, you're investing your money into a company. You're literally buying a piece of a business. Like if you go out and buy 1 share of the Amazon stock, you become one of the owners of the Amazon company. Now, the thing that I want you to understand here, that you don't have to go out and find the next Amazon or the next Google in order to make a lot of money. And this is the first mistake that so many people make when it comes to investing their money in the stock market, is they think they have to find the next hot stock. But the reality is, for probably 90 to 95% of people, you shouldn't be investing in individual companies. Why? Because most people don't have the interest or the education or the psychology to actually invest in individual companies. Because the reality is, when you invest in individual companies, if you really want to make money, you have to first understand, how do you actually analyze the company? What research do you do to keep up with the company? How do you keep up with the numbers? How do you keep up with what the management's doing? How do you listen to the earnings calls? What information should you be paying attention to? Most people don't care about that, and if you do care about it, well, a lot of people don't have the education or care about putting the education in to actually do that. And then if you are willing to do that, the next group of people don't have the right psychology to actually manage their investments, because the reality is market crashes happen. You're going to see booms and busts. And what ends up happening now to most people is they end up losing money in the stock market, when historically over the last 100 years, the stock market has gone up over the long term. Why? Because most people start selling and panicking when the market goes down, while smart and savvy investors are buying. And it's not easy to now actually do it. It's much easier to say it than actually do it, because now when you see your portfolio in the red, it can be very scary, and most people tend to panic, and then they make decisions based off of emotions, not financials. This is why most people shouldn't be going out and buying stocks, when the next best thing is buying something like a fund, potentially an index fund or an ETF. This is where now you're not investing in individual companies, you're investing into a group of stocks. That way now you don't have to worry about doing the research in individual companies, you don't have to worry about keeping up with all the companies, and now you just want to create a system where you're automatically buying some of these funds over the long term. Every week, every 2 weeks, every month, no matter what, you're just going to keep buying. If the market's booming, you keep buying. If the market's crashing, you keep buying. The only change that you'd make is maybe you buy even more when the market is crashing, because it gives you the opportunity to buy even more at a discounted price. Now I'm going to go over a few fund examples, but I want you to understand that 1, I'm not telling you what to buy, and 2, investing has risks. You're never guaranteed to make money when you invest, which is why you need to always do your own research and never blindly trust a random guy on YouTube. So if you wanted to just invest your money in the stock market, you can invest in a fund like VTI. VTI is the total stock market ETF created by a company called Vanguard. What does that mean? If you go out and invest in the VTI ticker symbol, you're investing in literally the entire US stock market. So if you buy this one fund, you're buying a little piece of a lot of stocks on our stock market, which means essentially if the stock market goes up, your fund goes up. If the stock market goes down, your fund goes down. SPY is another fund which gives you exposure to the S&P 500. That means now you're getting exposure to the 500 largest companies on the stock market. SCHD is a fund that gives you exposure to dividends, dividend-paying companies. Now, I put a little asterisk here because as a disclaimer, I do own SCHD. And so now the question is, how do you want to get paid and what is it that you want to invest in? If you just want to throw your money into the stock market, well, VTI can give you that exposure. If you want to invest your money into the biggest companies in the stock market, SPY gives you that exposure. If you want cash flow, SCHD can give you that exposure. Now, this is where you have to start thinking, what type of investments do you want to make and how do you want to get paid? Because most people think of investing as, I'm going to put my money into this thing and then I'm not going to see this money until I'm 65 or 70 years old. I like to look at investing like, I want to invest my money into something and start generating some cash flow now. That's why the bulk of my investments, not all, but about 75% of my investments are cash flow producing assets. That means that I buy something and it pays me with cash flow. So the bulk of my stock market investments pay me with cash flow. The bulk of my real estate investments pay me with cash flow. I like cash flow just because it gives me cash in my hand today and I can more reasonably predict how much cash flow I'm going to get as opposed to how much a stock or how much a real estate property or how much a business is going to be worth at some point in the future. If property prices and stock prices go up, that's icing on the cake. But I just want that cash flow because the cash flow gives me cash that I can use today. And now if you're working to build up $100,000, the cash flow is putting more cash in your account, or that cash is being used to buy you more shares. Because for me right now, with my stock market investments, the things that are paying me cash flow, I'm not using that money. I'm taking that cash and I'm reinvesting all of it. So I get the cash flow from my investments every 3 months because I get my dividends every quarter, meaning every 3 months. And then this money goes right back into the market to buy me more cash flow producing assets. So every week, the way it works for me is every week I have cash going into my funds. Then most of these funds are paying me with cash flow, which goes back into these funds to buy me more cash flow producing funds. So it's like a machine that's working to produce more cash flow while I'm throwing more money in there to buy more of the cash flow, which brings me to number 2, which is real estate. Real estate is one of my favorite places to invest because when you invest in real estate, now you're buying something tangible. You buy something that you can see, feel, and touch. You buy the bricks, you buy the land, you buy the windows, you buy the doors, and then you can also create cash flow. So now the way it works is you're gonna go out and you're gonna buy this property and then you're gonna rent it out to somebody else, and then somebody, that's supposed to be an arrow, somebody is gonna come in and live in this property and they're gonna pay you rent. Now if you do this the right way, this rent should cover all of your expenses. That includes your property taxes, your insurance, your maintenance, your management fees, and cover your vacancy costs, and cover any debt that you might have, and then put some money in your pocket. Now, does this mean that every real estate deal is going to be profitable? No. This is where the research comes in because, well, right now you have a very hot real estate market, which means it's harder to find a good cash flow producing deal. Does that mean that there's no deals out there? No, it means you got to be pickier and you got to work to find the good deals. And this is where, again, that financial education comes into play. Now, should everybody be a real estate investor? Of course not. But it creates opportunity for the right people. Now, if you don't want to go and actually invest in real estate, there are funds that you can put your money in that will give you exposure to real estate properties. I have an example of one of my affiliate companies that allows you to do this down in the description. But this is where just understanding that you can get cash flow from different places, and then if real estate prices go up, well, that's icing on the cake. If real estate prices go down, well, at least you're still getting that cash flow. This is now where you have to make that decision of how do you want to invest your money. Do you want to invest your money and see the future growth, or do you want to invest your money and see the cash flow? For me, I like cash flow. That's why the majority of my investments are cash flow producing, and some are not. But you got to figure out what are the right investments for you. That way now you're working to put that money aside, but then your money is also working to make you more money. Number 4, I want you to manage your 2 S's, which is your spending and your saving. And I'll start by talking about saving because the reality is your savings are not going to make you wealthy, and your savings are probably going to lose value to inflation. If the interest rate that your bank is paying you is lower than what inflation is, your savings are effectively making you poorer. Now, that being said, that doesn't mean you shouldn't have any savings. That means you need to save your money strategically. That means you want to have somewhere between 3 months and 12 months worth of expenses saved up. Now, I know this is a big range, and the reason why it's a big range is because, well, it depends on where you are in life. If you're young, you don't have any financial responsibilities, you have more freedom to be more risky, and maybe you can take on more risk, which means you might only need a few months worth of expenses saved up. If you have kids, you have a spouse, and you're not really open to this whole idea of taking risk, and you don't like this idea of investing your money, and you feel safer with the cash cushion, then maybe you have somewhere between 6 and 12 months worth of expenses saved up. You got to find what's the right number for you, but somewhere between the 3 to 12 months of savings saved up here. Once you build that savings cushion, now you're no longer going to save money, and you're going to reallocate that money here towards your investments, because your investments are what's going to make you wealthy. But in order to do this, what I want you to do is look at your credit card statements, look at your bank statements, see how much money you're spending every month. Add up your rent, your mortgage, your utilities, your car payments, your car costs, your gas, your food, your eating out, your travel, whatever your costs are. Multiply the number by 3, multiply the number by 12, and that gives you a range of how much money you need to save. Once you hit that number, well, now you can stop saving that money. You can leave the bank account there because this is your cushion. Then you can start investing that money. The second S that I want to talk about, though, is how you spend your money. Because a lot of people assume that if you can buy something, that means you can afford it. But the reality is being able to afford something is very different than being able to buy something. Because if you have $100 in your account, you can go out and buy a $500 phone. But the reality is you can't actually afford that $500 phone or the $500 Gucci belt or $500 whatever, because financing doesn't mean that you can afford it. See, when most people think of affording something, they think I can just afford the payments. But now if you really want to become wealthy sooner, and if you really want to achieve that financial success that you want sooner, and you want to have to stop kind of spinning your wheels in this financial system sooner, you got to stop playing in the same game as everybody else. And that means you're going to have to control the way that you spend your money. And that means from now on, if it doesn't put any money in your pocket, don't use debt to buy it. The only exception to this would be the house that you live in. But if it's not putting any money in your pocket, don't go into debt to buy it. So what does that mean? You want to go out and buy a new car? Great. Don't get a car payment. If you want to lease a car, okay, well, you got to be really rich to be able to do that. Leasing a car is like going and flying first class. Flying first class and sitting economy is going to get you to the same place, but flying first class is a whole lot more comfortable. Leasing a car is very comfortable. It comes with a lot of perks, but you got to have the money to be able to actually afford that. That means if you can't afford to buy that car comfortably with cash many times over, don't even think about leasing it. So if you want to get a car, buy a car that you can afford with cash. That way now you don't have to worry about the monthly payments, because now when you don't have to worry about the monthly payments, all of a sudden you're going to have a whole lot more extra money every single month, because now not only are you not putting the money into the monthly payments, you don't got to pay for the premium gas, you don't got to pay for the expensive insurance, you don't have to pay for the expensive maintenance, and now you have a whole lot of extra money every single month. Yeah, maybe you don't have the BMW anymore, but you still got the extra money, which can be used to make you wealthier. And now when you become wealthy, hey, go out and buy the BMW or the Benz, and you don't have to worry about the price. So now we talked about how to spend your money the right way. We talked about how to invest your money, that way you can grow your money. We talked about how to save your money, and this brings me to number 5. If you really want to amplify how fast you can put aside the $100,000 or take it to $1 million or whatever it is that you want to hit, you got to earn more money. Because now if you want more money going into each one of these buckets, you need more money flowing in. As soon as you start doing this, you're going to love the idea of investing. You're going to see the potential growth. You're going to start running the numbers. You're going to say, you know what, this is cool. And yeah, you might start spending less. That way you have less money going out. That way you have more money to invest here. But there's a limit to how little you can spend. But there's no limit to how much you can earn. And this is where things really get fun. Because when you understand this, now you're going to be looking for new and creative ways to earn more money. That way you can increase how much money you're putting here. Because if you can grow from $50,000 a year to $500,000 a year, now you really can amplify how much money you're spending, investing, and saving. And the first time I say that, you might hear, Jaspreet, where in the world am I going to go from $50,000 to $500,000? Like, that's not even in the realm of possibilities. Well, this is where you have to start thinking a little bit different than what you might have been doing. Because now if you really want to start earning more money, you might have to create your own income. You might have to work to create a side hustle. Start watching YouTube videos on how to earn more money. Start reading books on how to earn more money. If you start opening your mind to the possibility that you can earn more money, now you might start taking actions on how you can earn more money. Because if we just keep doing the same thing every single day, you're just trying to earn more money from your job, maybe you'll get some pay raises here and there, but it's not going to be what you need if you really want to take it from $50,000 to $500,000. And if you want to 10x where your income is, you're going to have to start changing the way you think, and you're going to have to start changing what you do. But in order for you to do that, you have to believe it's possible first. And if you believe it's possible, well, then you're going to start putting in the action to actually make it possible. What are different things that you can do? Well, the internet has made starting a business or creating an income so much more accessible. This could be creating a product. This could be creating your own business. This could be working to provide value to other people on the internet. It could be a side hustle. You can be a freelancer. There are an unlimited number of things that you can do. Now, if you tell me, Jaspreet, I hate the idea of being an entrepreneur. I hate the risk of trying to start my own thing. I hate the idea of trying to manage that type of stuff. Well, that's okay. You don't have to go out and start a business. You don't have to go out and start a side hustle. If you really don't want to do that, then now you want to find a more creative way of how you can earn more money. If you can't do it from your job, if you can't do it from your career, can you add on a second job? If that's not practical either, then how can you increase your income? Can you get a certificate online? Can you get some sort of certification online? Can you do some sort of education that will allow you to earn more money? There's a lot of online certifications that will take some time, that might cost you some money, that will allow you to earn more money. If you can start doing these things and maybe get a new career or find a new job that will allow you to earn more money, now the key is when you get a raise in your income, you don't want to just raise your spending without raising these. That's why we're following a plan that will scale with your income. Because the biggest mistake that so many people make is that as soon as they start to inflate their income, they start to inflate their lifestyle without inflating their investments and inflating their savings. So as you start to earn more money and as you work to earn more money, you got to make sure that you're also increasing this and you're increasing this along with this. That's why you want to have a scaling route where now as you earn more money, you're also spending more, investing more, and saving more. That we're always paying yourself before you go out and make everybody else rich. There are 5 keys to being a successful real estate investor. Number 1, you need to know how to find a good location. Number 2, you need to know how to build a good team. Number 3, you need to know how to run the numbers. Number 4, you need to know how to do the due diligence on the property. And number 5, you need to know how to increase the value of your investment. These are things that I learned over the last 12 years of investing in real estate, making a lot of expensive mistakes and seeing some success. So let me start by talking about number 1, which is understanding the location. The 4 factors that you want to be paying attention to when you're looking at a good location is the crime in the area, the population and population growth, businesses moving in or out, and the walkability of the area, especially if you're looking at a city, a more urban environment where people can actually walk around places as opposed to a suburban environment where people have to drive places. So let me start by talking about crime. I mean, the general consensus is people want to be in a safe place. And so you can go do a Google search to see the crime in your neighborhood, see the crime in the city, see the crime in the county, and see the crime in the general area. And if you see crime increasing, that's a bad sign. If you see crime decreasing, that's generally a good sign because tenants want to feel that they're safe in your home. But you want to take this factor with a grain of salt because Manhattan has a lot of crime, but people want to live in Manhattan. California has crime. People want to live in California. Just because it's crime doesn't mean it's not a good place to invest. It's something that you want to be paying attention to if crime is rising or if crime is going down. And you're not always going to get a good answer by just searching crime scores and looking at crime maps on the internet. This is where you got to get the feel of a neighborhood where you're investing, because real estate is very localized. And you don't want to just throw your money into an area because you think of something good that you found on Google. You want to actually drive the neighborhood, walk the neighborhood, stay there for a little while and get the feel. You're not going to be able to get that real feel of the area without actually spending some time there. And if you want to actually be a real estate investor, you need to spend time in the areas that you are investing. If you don't live there, fine, drive through it, walk through it. Do you feel safe walking through it? And is this somewhere where you wouldn't mind spending some time? Second, on the population side, do a quick Google search of the city and neighborhood that you're looking to invest in and see the population. So go to Google, search Manhattan population. And what this will show you is the population and the population trend for Manhattan. And you can do this for different neighborhoods, different cities around the country. And what you want to see ideally is populations rising, or at least populations staying stable, but you don't want to see populations dropping, because if populations are dropping, that means that the amount of tenants in the area are probably also dropping. And you want to be investing in an area where more people are moving to, because if there's more demand for your property in the future than there is now, that means that rent prices will probably have to go up because more people want to live in the area that you own that real estate. Third, you want to be investing where businesses are moving to. So this is a little while ago now, but I remember I was looking at some real estate in a city that's near me, and there was a city block that was completely vacant. And it had some big real estate that was all vacant, and it didn't look good. And I asked the city about what was happening here, and what they said is that a Walmart had just entered into contract to purchase all this land, to purchase the building, and they were planning on opening a Walmart supercenter. When I heard that, I started buying up some of the real estate near this area, and over the next few years, not only did Walmart open up a supercenter here, but then you had all these other new retail stores that opened up around the Walmart, because Walmart brings a lot of traffic. People want to go to Walmart. And so that opened up all these other new retail shops, and then new real estate developments opened up on the other side of the street, which was also vacant, and this drove a whole new set of traffic and businesses into this area, which meant more people wanted to be here, more people wanted to shop here, and more people wanted to live here, which not only increases the value of the real estate, but it also increases the rental prices of the real estate. Now, how do you find where businesses are moving to? Now, you can look at the press, you can look at the news, but many times if it's already hitting the news, it might be a little bit too late. And this is where real estate is special, because this type of insider trading, insider investing is not illegal in real estate. In fact, it's completely legal. So how do you get this information? Well, one of the best places to go is actually the city hall. Just go to the city hall, the building department, and ask them if there are new businesses coming into a particular area. Is there some new developments coming? What's new happening in this city, in this neighborhood? And they'll tell you. And if you hear something interesting, that a big business is coming, that Amazon is opening a new Whole Foods, that Best Buy is doing something, that something is happening. I don't know why I said Best Buy, but something is happening here that's going to be driving new demand, that's going to be driving new businesses. That can create opportunity for you, because now you can capitalize on the increase in real estate value in the area by owning some of the real estate. And then when rent prices go up, well, now you get to reap some of the rewards of that. And finally, you have walkability. So if you're investing in cities, walkability is extremely important, because people want to be places where they have easy access to buses, easy access to subways, easy access to public transit, and easy access to food and groceries and everything around them. So walkability is extremely important when you're investing in those types of city and urban areas. But this is where you got to understand what type of investor do you want to be, because you also have some investors that hate the idea of investing in big cities. I know some investors that I work with that do the complete opposite. They invest in more rural type areas, and what they say is that one, there's much less demand, they're not competing against other investors, and second, the tenants that live there stay longer because they just live in these rural areas for much longer and people don't really move. So it's a completely different game, completely different demographic, but it creates opportunity for, depending on what type of investor you want to be, it creates opportunity for you if you know what the goals are. If your goal is to be investing in the rural type areas, you really got to know the neighborhood, you really got to know the people, and you're not going to have the same type of demand as you would in this heart of Manhattan. And so you got to understand where do you want to be, and the returns that you're going to get are also going to be different. You have smaller returns in Manhattan generally if you're looking at a cash on cash investment, because Well, it's much more expensive to buy in Manhattan than in a village somewhere. But in that village, you're not going to have thousands of tenants and thousands of people that are willing to make applications to live in your place. So you're going to have higher vacancies, and you're going to have higher wait times. And if you have a turnover, that can be more costly. So you have to understand where it is that you want to be, or somewhere in the middle as a suburban investor. So there's many different types of investing, and each one is going to have their own goals and have their own interests, and tenants are going to want different things. If you're investing in cities, that's great. But you got to understand that what people want is walkability, and something that will help you understand this is going to walkscore.com, and you can see what the walkability is for a particular address and a particular neighborhood, that we can see if that's somewhere where people would like to live. The last thing that I want to mention on location and walkability is you can also consider investing where walkability will be increasing. Like in Detroit, there was a new rail that was put in, and many investors started buying up land around where this new rail was going to go to start investing in this new walkability, because this new rail was going to create a new line of public transit, and that would open up more opportunity for people to go from one place to the other. And so people started buying up the real estate all around it in anticipation for the new rail. But you just got to make sure that it happens, because if that new rail isn't as good as what people would expect, then you might be buying up this real estate and then find out that it's not as valuable as you would like. So you got to be careful with that type of speculation, because there are risks involved with it, but it can create opportunity if you see the walkability increase. The reason why location is first is because you can change everything about a property except its location, which is why location is so important. Now this brings me to number 2, which is understanding your team. And I'm going to be highlighting 8 different team members that you need to have if you're going to be investing in real estate. This is your property manager, your real estate broker, your accountant, your contractor, your attorney, your banker, your title company, and your insurance company. Let me start by talking about your property manager, because either your property manager is going to make your life completely miserable, or they're going to make your life very free and clear. I have worked with a lot of property managers. Some of them are great, some of them are very, very bad. And the bad ones will make your life literally a nightmare. My first property manager that I ever had, I don't even know if they were a real licensed property manager or not, but my tenant had my phone number, and so my property manager did nothing. They were collecting the rent, they were collecting their fees, but my tenants would call me anytime something went wrong. Now, the whole purpose of a property manager is to make real estate passive for you. When you buy the property, you're supposed to give them the keys, and then they're going to manage everything. They're going to find the tenant, they're going to make sure the tenant pays, they're going to make sure the bills are paid, they're going to handle all disputes with the city, with the tenant, and everything in between, and then they're going to take a small fee. This fee might be somewhere between 4% to 10 or 11% of your gross rental income, depending on how many units you have, depending on how much work that they're going to do. Now, this is a cost to you, but it also saves you a whole bunch of time, because now the real estate whole investing process can be completely passive on your end, and your job is to be a real estate investor, not a real estate manager, which is why I never manage my own properties. But my first property manager was a property manager who was supposed to make it passive for me, but it was anything but passive. So I was getting calls from my tenant, I was dealing with all the issues, and eventually I fired this property manager, and I got another property manager. Now the second property manager was a lot better. They documented everything. I had a lawsuit happen in one of my real estate properties where a tenant sued my real estate company because they said that the bathtub got too slippery when the water was on, and it caused them to slip and fall because the bathtub was too slippery. Well, anyways, that case got thrown out because ultimately they figured it out that the tenant didn't slip in the bathtub. The tenant ended up slipping at a barbecue. They were just trying to go after some money, and they did get some money, but the tenants actually didn't get any money because my insurance company settled with them, and they didn't make enough money to even pay the attorney fees, so the tenants ended up getting nothing. But that's real estate, and that's the way the world works, especially here in America. We are the most litigious country in the world, so you have to be prepared for these types of things. Well, having a good property manager can definitely help with that, because one of the things a property manager is supposed to do is document everything. Every time your tenant has any sort of communication with the property manager or with the contractor, this needs to be documented. And if you are the one that's documenting everything, well, it's going to be a huge pain in the asset. This is why I don't recommend you doing that. This is where you want to have a good property manager to do that. Well, that same property manager company had some changes internally, and then they started not really managing properties. I had a property, and this is here in Michigan, where it gets cold. I had a property that didn't get winterized, because when it gets cold in the northern states, you have to winterize properties. That way pipes don't burst when tenants are not there and when the heat is not on. Well, this property was not winterized, and then a pipe burst because, well, nobody was there, and for some reason the heat didn't work. And now the pipe burst and the whole property got destroyed and nobody knew about it. This property just kept flooding and flooding and flooding. And then eventually somebody from the property management team went out there to go show the property to get it leased out, and then they see that this property is completely flooded, and this created a huge mess. Well, that property management company then had to pay me a lot of money, and then I fired them. So this is where you have to make sure that you have a good property manager. Now, how do you find a good property manager? Well, you have to ask them a lot of questions. One, how are they getting paid? Some people say that it's very bad to pay a property manager a flat fee because now they're getting paid even if a property is vacant. I've had different experiences where it's not that big of a deal if a property manager charges you a flat fee so long as they do a good job. I don't like when property managers are going to charge you a fee to then do any sort of construction work. What that means is a property manager is going to do all the repairs, or they're going to go find a contractor to do the repairs. You're going to have to pay for the repairs. That's the way it works. But then if the property manager is charging you a fee to then manage and issue the repairs, that I don't like. Because many times what I've seen happen in the past, with myself as well, is when a property manager is charging you a 10% fee on top of whatever the repair is, they're not going to have the best incentive to go out and get you multiple bids to find you the lowest price possible to do a renovation, to fix a deal, because the more that you have to pay, the more the property manager makes. So I don't like that. Second, when it comes to the way that they handle tenants, you need to understand what are their policies when it comes to issuing the eviction notices? What are their policies when it comes to being lenient on tenants? Because you want to make sure that whatever their policies are align with you, and you need to make sure how you get paid. When there's a late fee, who gets that money? Is it the property manager or is it you? I don't think it should be the property manager. I think it should be you. Maybe the property manager takes a little bit if they're going to be issuing notices for the late fee or because the tenant's late. But that's money that you should be receiving, not your property manager. So you want to be asking these questions and understand what their protocols are and know where you can find all the information about your properties, about your leases, and about your P&Ls, your profits and losses. That needs to be figured out early on. So ask these questions to your property manager. Second, when it comes to your broker, the biggest mistake that I see real estate investors making is they try to find a real estate agent who's well known, a good real estate agent, and then they want them to represent them to find them real estate deals. Well, a regular real estate agent is helping people buy and sell the home that they live in. They're not helping real estate investors find a real estate investment deal, because a real estate investment deal is very different than the home that you're going to be living in. And the real estate agent who's going to be sending you deals is going to show you deals that somebody would want to live in, but not something that you want to invest in. And these are completely different deals, because a cute home is going to give you cute profits. And you got to decide, do you want the cute profits or do you want the big profits? And it's going to be a completely different way of the way that you look at deals, the different way that you look at properties, different locations, different types of properties, because somebody who wants to live in a home might not want to buy a beat up property. But that beat up property can make you much bigger returns if you come in and renovate it, because you'll be able to buy that property for a huge discount, and then you can fix it up and then rent it for a better price, because now you have a fully renovated property and you got it at a discount. So you want to make sure you have a broker that specializes in real estate investment deals. And even if you are a real estate licensed salesperson like I am, I'm a licensed salesperson. I got licensed when I was 20. I used to work with people who wanted to buy and sell homes. I worked with investors. I work with a bunch of people, but I don't broker my own deals. I have another broker that I work with. I go look at the properties. I'm licensed, so I can go and do that. But then when I want to do up the paperwork and do all that stuff, I call up my broker and I have them fill out the paperwork, and then they send it to me, and then I sign it and send it back to them. That way my work is less. I want it to be as passive as possible for me, so I have a broker that I work with that does all of my contracts, and that way now he takes a piece of his commission. I still get a little bit of commission, and I just put that into the deal because I am a broker. But this is where understanding what are your goals. Do you want to be doing all the work to find the research, to find the properties, or can you hire somebody to do that? And that's where a good broker can help. Then you need a good accountant. I cannot tell you how valuable a good accountant is, because I've had a bad accountant and I've had a good accountant. And if all your CPA is doing is filing your taxes, you are leaving a lot of money on the table. And if you are going to be investing in real estate, you absolutely need a good accountant now, because now it's not just showing your W-2. There are so many different deductions, so many different things that you can do in real estate to allow you to make money and pay less money in taxes legally. And your accountant has to understand and specialize in real estate investments because there is so many different types of deductions, so many different legal loopholes that you can use with real estate that will allow you to pay less money in taxes legally. And you want to bring the accountant on and make them informed from the early stages. As soon as you buy the property, that's when you need the accountant to understand what's going on, because there's so many different things that you can do when it comes from buying the property to doing the depreciation to potentially doing accelerated depreciation to then potentially offsetting some of the income that you make outside of real estate through the real estate that you're buying. So talk to an accountant about the different strategies that you can use, where you use real estate to offset some of your other income and where you use real estate to generate cash flow but pay less money in taxes legally. Fourth, you need a contractor. Again, I've learned this the hard way because I've had good contractors and I've had very bad contractors. And very bad contractors will save you a lot of money right now. But if things go wrong, then not only are you going to have to pay to fix their work, but then you're going to have to pay to do the work right. And I have dealt with this on multiple occasions because in the beginning when I was getting started, I found the cheapest of the cheap contractors and they did work cheaply, sometimes quickly, sometimes not so quickly. But it's such a pain where you have to stand over them every single day to make sure they're at your property, to make sure they start working. And then when they're not working, you got to call them to see where they are, because then they start another job in the middle of your job. Get a good contractor. It's going to cost you a little bit more, but it's going to save you so much headache. It's going to save you so much time, and it's going to save you money in the long run, because when you have to keep paying to fix up your previous contractor screw-ups, it really starts to add up. And then it makes tenants upset because things keep breaking because your contractor didn't fix it the right way. So now I work with a licensed and insured contractor. And yes, they charge me more money, but it costs me way less headache and my things get done correctly the first time. Pay more to do it right the first time, because if you don't, well, 5 years later, you're going to understand why it's way cheaper to have a good contract to do it right the first time. You all learn. Everybody learns at some point. Then you need a good insurance person, because guess what? As a landlord, you need a good insurance. You need landlord's insurance and you need liability insurance. I talked about the time that I got sued because a tenant claimed that the bathtub was too slippery when the water was on. And, well, I had to go through my insurance, because now you need an attorney, someone who's going to charge $300 to $500 an hour, who is going to sit there and defend you. Now, even though I was right, somebody still had to pay the attorney hours worth of work to go through the whole process to get this case settled and dismissed. And yes, we had to go through a settlement because it was stupid. The judge wouldn't see it. The judge said settle this outside of court, but you still needed an attorney to do that, and then the insurance company had to give the other party some money so they go away. The tenants who were suing me didn't make a penny, but we still had to go through this whole process because that's the way the system works. It's crazy, I know, but this is why you need insurance. So make sure you have landlord's insurance, make sure you have liability insurance, and it doesn't hurt to spend a little bit of extra money to up the insurance, because we live in a very litigious country. Then you need your title insurance. Now, title insurance has been known to be one of the biggest wastes of money when it comes to insurance. Well, it is a waste of money that you hope becomes wasted, because guess what? I've also dealt with title insurance issues. This is what happens when you go through a lot of real estate deals. Title insurance is something that protects what you buy. So if you buy a property, you think you're buying a home, what title insurance says is that you're actually buying the home that you think you're buying. In case somebody from 10 years before comes and says, no, I own this property. You bought it from somebody who didn't actually own it. Title insurance is there to protect you against those types of situations. They are very, very, very rare. But when they happen, that's when title insurance can be valuable. Now, title insurance is something you get typically when you just close on the property, but you want to make sure that you have title insurance, because there's some times when you go through auctions, you go through foreclosures, that you don't get this type of title insurance, but you want to make sure that you get this because it can save you a huge headache. I bought an apartment complex on a lake. And this apartment complex was made up of 4 different parcels of land. It was a beautiful area, beautiful complex. It was run down, but I was coming in to renovate it and turn it around, and I did. And a few years after I purchased this property, we fully turned the property around. We put in a ton of money into this property, and now it's fully rented, because when I bought it, it was completely vacant. Now this property is doing great, and it's producing a lot of positive cash flow. And then I get a letter from my attorney saying that apparently somebody else now owns a piece of my land. And I said, what are you talking about? So somebody had a claim on this land, and they had owned this claim to somebody else, a previous owner. And this never trickled down to me. and the title company never discovered this. So whoever owned this property and had this loan on the property wasn't making payments because they no longer owned the property, and then the bank, the lender that was owed money from the property, wasn't receiving money. So then they started issuing foreclosure notices. And where did they put these foreclosure notices? Somewhere on the property where nobody was going to see it. And so they put it on the property, and they knew that nobody was going to see it because apparently that's the way the game works, because they wanted to get the property, they didn't want the money, and this went on and on and on, and then eventually they put up enough notices, and then they got the right to the property. So now we get a letter saying, hey, you no longer own this piece of the property that cuts through some of the units, that cuts through some of the land, and now they say that we own this and that we have to pay them for it. So what did I do? Well, I told my attorney talked to my title company, and then my title company had to then settle with that previous owner. Yes, it is very rare, but you don't want to have to deal with the headache if it does happen. Then you need a good banker. If you are financing your properties, you want to make sure you have a good banker that is going to be there to then help you get approved, to help you get the financing, and then who's not going to screw you over later on when things start to go wrong, because the reality is the economy goes through ups and downs. And so banking, while it might seem just like a transaction, you need to borrow money from somebody else, it is a very much a relationship thing. So you want to make sure you know the person that you're working with, that they know you, they know your business model, they know your goals. So keep that relationship with your banker, because they're going to be able to save you a whole bunch of headache later on. And just like anything else, you gotta make sure you have a good attorney. Look, I am a licensed attorney, and I don't do any of my own legal work. I have a number of different real estate attorneys that I work with, people who specialize in different things, and you wanna make sure you have an attorney from the early stages of the deal. Even if you're buying a single family home or a condo, get an attorney early on board so they know what you're doing, so they can give you advice. That way maybe it's creating an LLC. That way they can make sure you don't miss the insurance part. That way you know you have all the things in place before you buy the property, that way you're protected legally, and that way your contracts are reviewed. And sometimes you might say, but it's just a standard contract. Yeah, well, sometimes it's not. And you want to make sure that nothing is sneaking through the contract that shouldn't be, that they make sure that your title insurance is what it should be, that they make sure that your closing is giving you exactly what you should be getting. So make sure you have a good attorney. The third thing that you have to do is run the numbers to make sure the deal makes sense financially, and you're going to always start with this, even if you're getting debt to buy the property. So you start with what you think the rent is going to be, then you subtract the property taxes, and if you're going to be buying this property, you have to calculate if property taxes are going to be going up, because if you're buying a single family home where somebody lived and now you're going to be renting it out, well, your taxes are going to go up, because most cities charge higher taxes to landlords than to homeowners. And if the property value, the assessed value, is going to be going up, well, your property taxes are also going to be going up. So you can talk to the assessor in the city, and they'll give you a better idea of what your property taxes will be after you buy that. So just talk to the assessor, see what the property taxes will be. Then talk to a couple insurance agents to get an idea of what your insurance will be. You need insurance. You subtract your property taxes, your insurance, your maintenance costs. Now, this maintenance cost is going to be a number that you're going to have to calculate. If the property is older, if it needs more maintenance, you want a bigger number here. If it's newer, well, you don't want to put zero, but something. A fraction of 1 month's worth of rent. So you could put a month's worth of rent or a fraction's worth of rent, depending on how new the property is and how much deferred maintenance is on the property. Then you're going to subtract your management fee. Even if you're managing the property yourself, which I don't recommend, you still want to pay yourself, because you have to make sure that you factor in your time, where if somebody else was going to do it, how much would they charge? So you got to make sure that the numbers make sense, even based off of yourself managing it. So if you are managing yourself, put in a number. If you have somebody else manage it, enter in what their number is, and then enter in a vacancy factor. Even if your property is fully leased out right now, eventually a tenant is going to leave, and you're going to have to then re-tenant that. And when they leave, there's going to be a period of time where nobody is in there, so you want to make sure you enter in a vacancy factor. I like to typically put in 1 month's worth of rent. It depends on the economy. Sometimes it might be 2 months or a month and a half, just depending on where you are in the economic cycle. But enter in a vacancy factor. So now you start with your rent, you remove these expenses. This is your NOI. If this NOI is big enough, well, that's a good deal. If this NOI is negative, that's not a good deal. Now, how do you know if an NOI is big enough? Well, what I like to look at is I take this NOI number, this monthly NOI, multiply by 12. So now you have an annual NOI number. This is how much profit you expect to make. Again, if you're using debt, we'll talk about that in just a second. But this is how much profit you expect the property to make over the year. And then you divide that by the price of the property. And this will give you something called the cap rate, or the return on your property. And if that number is high enough, well, then that's a good deal for you. If it's not high enough, then you want to keep looking. And I'll show you what that means right now. Let's assume for the purposes of this video that you can buy this property right here for $100,000. And this property is going to rent out for, let's just say, $1,100 a month. And you have $500 a month worth of expenses. So you go through the same analysis that I just showed you, which leaves you with $600 a month of projected NOI, projected profit. Now, I'm going to take this $600 of monthly profit, multiply it by 12, which means that I'm going to have $7,200 of annual NOI, net operating income. That's what NOI stands for, or profit. Now, I'm going to take the $7,200 of annual profit, NOI, and I'm going to divide it by $100,000, which is the total price of the property, which gives me a 7.2% return. For me, that is a good deal. I look for anything more than 7% here as the initial rule of thumb when it comes to investing my money. If it's more than 7%, I will consider the deal. If it's under 7%, it's not a good enough return. Now, this return is going to depend from area to area. Some neighborhoods are much higher, some neighborhoods are much lower. You got to decide what is a good rate for where you are. But for me, I know that I want a 7% return. This is where now you have to do your debt analysis. Let me wipe this off and show you what that looks like. If in this case you were to put down 20%, that would be $20,000. So now you put down $20,000, that's your equity, and you're going to be borrowing the other $80,000. And if you borrow the other $80,000, that's a 7.5% interest. That means now your interest rate is going to be costing you $560 a month, which means you have a $40 a month profit now, which $40 a month times 12 is $480. So $480 is your new profit. Now, the way that you're going to calculate your return now is you take your $480 that you're making in profit, and you're going to divide that by your equity, which is $20,000. Here now, it's about a 2.5% return on your money when you factor in debt, which isn't a very good return because now that you're getting debt, you have a higher risk. Because your higher risk is you have to make payments to your bank, so you want to be compensated for that. So you want a higher return here than you would if you just paid cash, and this is where you got to start with the cash analysis. Then you do the debt analysis, and you want to make sure if everything makes sense. If the location is good, the numbers make sense, the next thing you want to move on to is the due diligence. This is after you enter into a contract to buy the property, where you now review everything to make sure that everything is good. Now, before I go into the due diligence things that you want to work on, if you do want to stay up to date on what is happening in terms of real estate trends and stock trends and crypto trends and the economic trends, then you can join Market Briefs. It's my free newsletter that I created to help investors make better decisions. It's completely free, and it's a simple breakdown that you can read in less than 5 minutes every morning that will help you understand what's happening in the financial markets. That way you can make better decisions with your money. So if you haven't joined Market Briefs yet, I'll put the link to how you can join Market Briefs down in the description below. As soon as you enter into contract to buy a property, there's going to be 5 people that you want to call. One of them is not listed here. This person is whoever's going to be helping you finance the property. Whether it's a bank, whether it's investors, you want to call them to make sure you can get the cash, but that's not really going to be your due diligence. The due diligence is going to be working with 4 people. One is your property inspector, one is your property contractor, one is your property manager, and 4th is the city. Let me start by talking about the inspector, because as soon as you enter into a contract to buy this property, you want to make sure that this property is what you think it is. And this is where you want to get a private property inspector who's going to be walking through the entire property to give you a report on the health of the property. You have to do this, because I can tell you from experience that if you don't do this, you can run into a ton of mistakes. My worst deal ever was a deal where I trusted my contractor, who was not a property inspector, that I should go out and buy a property. He told me to buy a property because, well, he said that we could flip it for a quick return, and turns out that he really just wanted me to write him a check so he'd have some work to do because he was struggling financially. I ended up buying a property that was so run down that you couldn't see because it was covered up with a whole bunch of problems, where the pipes were completely frozen because somebody had poured cement down the pipes, where nothing worked, the HVAC units were shot, everything was just wrong in the property. Where it cost me tens of thousands of dollars, way more than what I expected, because I did not get a property inspector to walk through the property, to look at the pipes, to look into the basement, to look into the foundation, to look into the attic, to make sure that the property is what you think it is. So do yourself and do me a favor. pay a few $100s and get a good property inspector to walk through the property as soon as you enter into a contract to buy it before you actually close on it. That way you know what you're getting. Second, get a good contractor to walk through the property, because if you're going to be doing renovations, you need to know what it's going to cost you. And the price of things have always been fluctuating. So this is where, as soon as you know what's wrong, you know what you need to make changes on. And if you're going to do renovations, get your contractor to walk through the property so you know an estimate of what it's going to cost you to make the repairs. And if it's way more than what you thought, then you can back out of the deal. But if it's in line with what you thought, well, now you already have your quote, and as soon as you close, you can get the work started. Third, get your property manager to walk through the property. That way they can get an idea of what the property is. They can give you renovation ideas if things need to be upgraded, because they should know the neighborhood, they should know the city, they should know what tenants want in the area, and they'll be able to give you a good idea of what you can get for the property in terms of rent, and then you can make sure that what you can get for the property is in line with what you expect. And fourth, get the city involved, because you want the city to know that you're looking at buying this property, that you want to rent it out, because maybe they're creating some new restrictions on new landlords. You got to know that before you enter buy the property. Maybe they have some outstanding liens. You want to know this before you buy the property. Talk to the city, see what needs to be done in terms of licensing, because if they have their own requirements in terms of licensing, if they have different changes that they want to make, you want to know that beforehand, because if you don't know that, it can end up costing you a fortune after you buy the property, with a whole bunch of repairs and upgrades that you didn't know that you have to make. So talk to the city beforehand, before you close on the property, so you know what the total cost will be to turn the property around after you close the property. This is going to be done in the due diligence phase of the property. You always want to have a due diligence phase where you have time to do these types of inspections. If you don't do these inspections, you are taking on a huge risk. And the reason why I'm emphasizing this is because I made this mistake and it ended up biting me in the asset. So please don't make the same mistake that I did, and get these inspections before you close on the property. And the fifth thing that you have to understand is, how do you increase the value of your property? And for me, what that means is, how do I increase the cash flow from the property? Because when I invest in real estate, my goal is not to flip the property for a big profit. My goal is to generate cash flow, because I want enough cash flow from my real estate to be able to live my life that will now have this passive cash flow that I can use, and I can live my life without having to worry about the cost, because every month I'm going to get another cash flow check from real estate. So the question is now, how do you invest in your properties to increase the cash flow? And this is going to require research on your end, and this is where a good property manager can help you. Just yesterday, I was talking to a property manager of mine, and we were talking about an apartment complex that I own. And I was asking him what his thoughts are on buying another property, and what the different options were, and what my goals are, because he knows that I'm looking for a 7% cash on cash return on my deals. And he said, one of the things that we could potentially do is do a $250,000 investment into this particular investment complex. And what he says is that we will be able to increase our NOI by 11%. if I make this $250,000 investment by upgrading the bathrooms, by upgrading the kitchens. Because according to him, he does the research. He's been looking at different properties. He manages different properties in the area. He sees that there's more upside in the area, but we need better units. We need better kitchens. We need better bathrooms. And so if we can make this investment to improve the property, it's going to cost me money today. I can use that $250 grand to go out and buy another property, but it's harder right now to find a good deal. But if I take that same money and invest it into my own property, I can increase my rents, I can increase my NOI, and I can create a better property for my tenants. There's an unlimited number of things that you can do to increase the value of the property, but what you should do is going to depend on your market, and that's going to depend on what people are already willing to pay for. Now, you can be one of the people that's the trendsetter, you can be the person that's creating the new value, but typically that's going to require either a lot of money, because now you're going to be making a brand new development that's creating a brand new type of market in the area, or you're going to have something small and you're going to hope for somebody who wants an exceptional property that no one else is willing to pay for. If you're in the middle, I rather look at what other people are charging and make sure that I'm in line. That way I'm not overcharging people, I'm charging within the market, but I know that I have one of the best properties in the market. So look around. Are people having upgraded bathrooms? If so, what's in their bathrooms? Do people have upgraded kitchens? If so, what's in their kitchens? Do they have stainless steel appliances? I love putting stainless steel appliances in my units, because most tenants, when they come from other properties, they have those ugly, old, dirty appliances. But people love stainless steel appliances, and it doesn't have to cost you that much more to get a nice stainless steel appliance in your unit. Tenants love it, they're willing to stay longer, and many times you'll be able to charge a little bit more. If you can charge an extra $25 a month for your upgraded appliances, well, you might make your money back in 3 or 4 years. Kitchens, bathrooms, floorings, and ceilings can help you deliver a lot more value in your property, but you want to make sure it's in line with what's happening in your area. So if you don't want to be the person that's walking through the different properties for lease in your area to see what's possible, then get a good property manager who's going to be doing this for you, that can create a proposal about what needs to be done to increase the value of your properties. And then just naturally, when you upgrade a property, if it's a multi-unit property and you're making more money, it's going to be worth more money. And if it's not a multi-unit property and you upgrade a property, well, now your property is also going to be worth more money because you upgraded the property. Most people think that the way you build real wealth in the stock market is by finding the next Amazon stock before it pops off.
Amazing Amazon. The company becomes the second one ever to hit $1 trillion valuation.
This strategy works for some people, but not most people. Actually, when most people try to invest in stocks or pick stocks, they end up losing money, either because they overpay for the stock, or they don't know how to pick a good stock, or they sell their stock for a big loss because they get scared because something's happening in the economy, or they just sit on the sidelines and do nothing. However, everybody has the ability to be a millionaire stock market investor if you know how to do it the right way, and it's not by picking stocks, it's not by trading stocks, and it's not by starting off with millions of dollars. Let me show you. If you can invest $100 a month, and this is something that everybody should be able to do, if you cannot invest an additional $100 a month, then you need to go and watch some of my other videos about how you can live smaller or earn more money. That way you can put aside $100 a month. This is less than $4 a day. But if you invest $100 a month and you can get a 10% average return on your money, which historically has been the return of the stock market over the last century, and you do this for 46 years, you will retire with over $1 million in your investment account. If you put your money in the market and you can get the market return and you do this for a long enough time, you will be a millionaire. The problem is most people don't do this. Most people don't get these returns. Most people lose money and then they hate the stock market and they think that investing is only for rich people. And in this video, I'm going to go over how you can actually become a millionaire in the stock market. And it's not by picking the best stocks. But if you really want to see that success in the stock market, you have to follow a system. And this is the 3-step system that I'm going to be talking about. Number 1 is research. Number 2 is fund. Number 3 is automate. Let's start by talking about number 1. How do you actually research the right way? Now, when I talk about doing research, I'm not talking about researching individual stocks. We're talking about researching investment vehicles. And the 3 that I'm going to be talking about are ETFs, mutual funds, and index funds. And all 3 of these work very similarly with some little differences between them. But in general, the way that these funds work is instead of you going out and investing in a company like Amazon, now what you're going to do is you're going to invest in a group of companies. If you invested in the Amazon company, you put all of your money into this Amazon stock and Amazon takes over the world, this would be great news for you as an investor because now your stock price would soar. But if Amazon does something bad and the CEO runs the company into the ground and then they declare bankruptcy, well, now your investment go down to zero. So when you invest your money into the individual company, you're taking on more risk. You can see more upside, but you could also see more downside. And this is where there's a lot of work required to find the right company, to research the right company, and then you have the psychology aspect to actually how do you invest in the company. When's a good time to buy? When's a good time to sell? And this is why the majority of people lose money in the market, because they don't have the time to do the research, they don't know how to do the research, and they don't have the psychology to invest their money in the stock market. That's why for the majority of people, it's a much better idea to invest in these types of funds, because now the way it works is instead of investing directly into the Amazon company, you're going to invest into this fund which owns the Amazon company. And in addition to Amazon, it might own some McDonald's, it might own some Coca-Cola, it might own some Nike, it might own some other stocks in here. And now you have this basket of maybe 100 stocks or 500 stocks or 1,000 stocks. So now, if Amazon takes over the world, well, you're going to see some benefit here in the fund, but it'll be balanced out by some of the losers. However, if Amazon went bankrupt, then the fund would kick Amazon out and put another company in. So now you're not going to be hurt as bad by the Amazon bankruptcy because now they will replace it with another company and it'll be balanced out by some of the winners. So when you invest your money into these types of funds, you don't have to worry about doing the same type of research if you're trying to find the perfect company, because now this fund, whether it's an ETF, a mutual fund, or an index fund, is working to have the right group of companies there for you. That way now you're investing in a particular index, a particular basket of stocks, and I'll explain what that means in just a second, but you're picking this basket that you want to invest in, and then this basket will readjust based off of what companies should fit there. That way it's not a permanent group of companies. If Amazon goes bankrupt, it'll be kicked out and maybe Chipotle will come in. So these types of funds lower your risk, meaning they lower your downside, but they also lower some of your upside. However, if you're just trying to meet the returns of the market, these funds can allow you to do that without all the time and without all the risk. Now, how do you find these types of funds? Well, this is where you can look at ETFs, mutual funds, and index funds because they work similarly with a little bit of differences. So let me start by talking about mutual funds because these are what are generally known as actively managed funds. That means that the person who's managing the fund is actually a person. They're typically a well-educated money manager who you're going to be paying a fee to manage. Now, the good side here is you have somebody there trying to find you the best stocks to keep in this fund. The downfall is it's going to cost you more money. The fees are going to be higher. Sometimes the fee will be worth it. Most of the time, it will be not. Now, mutual funds work similar to index funds in that they have some restrictions. If you want to invest your money into a mutual fund, most of the time, they're going to have limits to how much money you have to invest. There will typically be a minimum. It might be $100, it could be $5,000, it could be upwards of $5 million, just depending on what the fund is. But there will generally be some minimums in order to invest. Not all of them have minimums, but some of them do. And then many times, mutual funds will also have restrictions on how often you can buy and sell this fund. Unlike a stock, you can buy Amazon and sell it within the same minute. When you buy a mutual fund, you don't have the same ability. Many times, not all the time, but many times, you can only buy the mutual fund or sell it once in a day, and there's only one slot to do that. So you can buy it only once in a day, so you can't trade out of these funds. This is kind of similar to index funds, but the difference between index funds and mutual funds is that index funds are generally passively managed. And what that means is now instead of having a money manager manage it, you are going to have a computer managing the fund. What that means is now you can build an algorithm that I'm going to invest in an index of the biggest 500 companies in the stock market. This is what the S&P 500 is. So now when you enter this algorithm, the computer will automatically make adjustments when it needs to be done. If Amazon goes bankrupt, well, then the computer will kick Amazon out and they'll put in the next biggest company. Now, the advantage of this is your fees are significantly less. Now, sometimes this will be great, other times not, but overall, what we've seen throughout history is for the average person, the higher fees tend not to be worth it. This isn't the rule 100% of the time, but generally higher fees mean it's going to eat up more of your profits. Then index funds many times also do have the same minimums like mutual funds do. This can be as low as $100 up to millions of dollars depending on what the fund is. And then index funds many times also have the same restrictions where you can't trade in and out of an index fund the way you can a stock. ETFs work very similar to index funds, but they can be actively or passively managed. So these are active or passive, but the difference between now ETFs and mutual funds and index funds is they trade just like stocks. So you have no minimums generally unless there is a brokerage that you're working with that doesn't allow you to buy a fractional share. For example, if the share of an ETF is trading for $100 a share and you don't have $100, some brokerages will let you buy a fractional share for $20. So you're buying $20 of a $100 share. But besides the restrictions to buy a fractional share, there's generally no restrictions to buy an ETF. There's no minimums and you don't have the restrictions because now you can trade in and out of an ETF whenever you want. This is where I want to remind you that if you want to succeed as this type of investor, this is called passive investing. If you want to succeed as a passive investor, the key is you have to be a long-term investor. And by long-term investor, I don't mean 6 months. I don't even mean 6 years. A passive investor is somebody who wants to invest in these passive investments for the next number of decades. When you have that type of long-term horizon, you can win as a passive investor, but you have to be in it for the long term. Personally, I'm a big fan of ETFs because of how easy they are to access, but for other people, that's exactly why they hate ETFs, because they don't want to have to sit there and monitor the stock brokerage accounts versus an index fund or a mutual fund. If you're buying it directly from the investment institution that's issuing it, well, now it's much simpler on your end because now you don't have to stress about what's happening in the stock market and staring at your stock brokerage portfolio each and every day. It kind of happens a little bit more discreetly because you're not seeing the day-to-day price moves the way you are with an ETF. This is where now when you're picking your investment vehicle, and I'm going to go over a bunch of different examples in just a second, you have to remember what your goal is as an investor, because that's going to help guide your investment decisions. And your goal can generally be, I want growth with my money, meaning I want to see the value of my investment go up, or I want cash flow, or a hybrid of these two. Growth means I'm investing my money into something that has more risk, but it has the potential to grow a whole lot more quicker. Because now these are companies that are generally smaller, they're trying to grow quicker, they don't have a lot of profits because they're reinvesting all their money back into their company, versus cash flow is now, this is a company that has big profits. They're making a lot of money, they're already very large, and now with their profits, they can just pay it out to their investors, people like you and me, in the form of dividends. So now you're getting cash flow in your hand. It's a little bit less risky, but you're going to see a little bit less upside because now these companies aren't going to be growing as fast as maybe a growth company. So a little bit less risk, but you're getting more cash flow today versus I want more risk for the potential for higher potential growth. Now, once you know what your goal is, this can then dictate how you're going to be investing your money. For me, the bulk of my stock market portfolio, especially my passive portfolio, is for cash flow, because for me, I like cash flow. Cash flow funds the guac flow, because when I have this type of cash flow, well, now I have investments that are paying me every single quarter, and every 3 months I get more money deposited into my investment account. Now for me right now, this money that gets deposited is being reinvested, buying more cash flow producing assets. So every week I'm putting money into my accounts. That way it can buy me more cash flow. And then when my cash flow investments pay me with cash flow, I'm using this cash flow to buy even more cash flow. So it's like a machine that's constantly working to produce more cash flow for me. Let's go over some examples so you know exactly how this works and what it looks like. Now, I gotta remind you that everything that I'm about to discuss are just examples. I'm not telling you what to invest in. You have to do your own research. Investing has risks. You're never guaranteed to make money when you invest. You might even lose money, which is why you need to always do your own due diligence and never blindly trust a random guy on YouTube. So let's go over some examples of how this works. Let's say you just want to put your money into the stock market. Well, there's an ETF for that. There's a total stock market ETF that gives you exposure to pretty much all the major stocks on the stock market. This is VTI. So if you invested in this VTI ETF, it is by an investment fund called Vanguard. You can look it up on Google. Go to Google and search VTI Vanguard, and you will learn everything about this. And what you'll see is that this gives you exposure to the broad stock market. So when you invest in this, you're getting exposure to the stock market. If you want to invest in the S&P 500, which is a group of the 500 biggest companies on the stock market, well, there's an ETF for that. And I should also tell you that these ETFs with a star next to them are funds that I have my own money invested in, just as a disclaimer. But if you want to invest in the S&P 500, then you have a couple ways to do that. You have SPY and VOO. Both of these are two different ETFs that both give you exposure to the S&P 500. They're created by different investment institutions, but they invest in the same 500 companies generally. The difference is SPY and VOO will have a slight difference in asset allocation. That means that they value some companies more than others, because both of these ETFs create funds of the 500 different companies, and then they allocate their money accordingly based off of what they think is the best. Well, VOO and SPY have some slight differences. Like they value Tesla a little bit differently. They value Johnson & Johnson a little bit differently. But besides that, they work primarily the same way. Now, these are two ETFs. VFIAX is the index fund version to invest in the S&P 500. So now, if you put your money into this index fund, now you're investing into the S&P 500 through an index fund as opposed to an ETF. VOO and VFIAX work very similarly. This is an ETF, this is an index fund. They're both created by the same Vanguard. If you wanted to invest in the NASDAQ, which has a lot of exposure to tech companies, then you can look into the QQQ ETF. If you wanted to invest in the Dow Jones, you have DIA. If you wanted to invest in just value companies, well, Vanguard has an ETF for that. It's called VTV. If you wanted to invest in emerging markets, these are countries and companies overseas that don't rely on the dollar, that are working to grow. This is VWO. So it's a way to diversify your money outside of the United States. And if you want to invest your money into dividend-paying ETFs, this is an ETF that invests in high dividend-paying companies, then you can look at something like SCHD. This is a dividend ETF. Now, let me remind you that this is not a comprehensive list of ETFs. There are so many different ETFs out there. There are even more ETFs than just this for dividend or emerging stocks or everything else. There are so many ETFs out there, which is why this is just a place to start, and then you can start doing more research. But this is where now you can start asking, who is the company that's issuing the ETF? Because if it's a reputable company, well, then that gives you a little bit of assurance. Then you want to look at the number of assets under management, meaning how much money does this fund actually manage? This is very easily accessible information with a quick Google search. And then you want to research what are the actual assets in this fund. Like when we talked about VTI or VOO, you can see that these invest in a particular group of stocks, and each website will show you which companies are listed in this particular ETF. As an investor now, it's important for you not just to stay up to date on what's happening with your investments, but what's happening in the broader economy, because that can influence your investments. And an easy way for you to do that is to join something like Market Briefs. It's a free newsletter that I created to help people like you, to help investors stay up to date on what's happening in the financial markets. It's super easy to read. You can read it in less than 5 minutes every morning. And every day we're breaking down what's happening in things like the general economy, the stock market, the housing market, crypto, the global economy, into a fun, witty, and easy to read email. So if you haven't joined Market Briefs yet, it's completely free. And I'll put the link to how you can join for free down in the description below. The last bit that I want to talk about when it comes to the research aspect of knowing what you're investing in is looking at the expense ratio and the yield. The expense ratio is the fee that you're going to have to pay for investing your money into a fund. Whether it's an index fund or an ETF or a mutual fund, all of them are going to have a fee, and the fee is called the expense ratio. And this is very easy to find. You can go to Yahoo Finance to find this, Seeking Alpha. You can go to the actual investment institution that's issuing the fund. You just have to look at what the expense ratio is. And what you'll see is that this expense ratio is the fee that you're going to pay every single year for investing your money into this fund. When we talk about part number 2, I'll show you the real cost of this fee, which is why you want to have ideally a lower fee if possible. And then the second thing that you want to understand is the yield. This is the dividend. This is the cash flow that you get. Now, sometimes you're going to be investing in funds for the cash flow. Other funds, you might not be investing for the cash flow, but they might be paying cash flow as well. This yield is the cash flow that you will get. So if it says it's a 1% yield, that means if you invested $100 today, you will get $1 in cash flow just for owning the investment. And this is cash flow that you're getting, not for selling the stock, but just for owning the stock. This brings us to the second step of becoming a millionaire stock market investor, which is now how do you actually fund your investment the right way? Now, in the beginning of this video, I talked about how if you want to become a millionaire stock market investor, you could just invest $100 a month, get a 10% annual return for 46 years, which would reach $1 million investment portfolio after 46 years. However, what I want you to understand now is that there's 3 aspects which will influence how wealthy you become in the stock market. And these 3 factors are how much money you invest. Here, we talked about $100 a month. Number 2 is the return that you get. Here we talked about the 10% annual return. And number 3 is how much time you invest your money for. Now, the only factor that we cannot change is time, because you cannot go back in time and start investing 10 years ago. So we're not going to talk about that, which is why the best time to start this is today, regardless of where you are in the economy, because, well, the more time, the better. Time in the market beats timing the market. This is what Warren Buffett always says. So now we have 2 factors that we can talk about. One is how much money you invest, and second is the return. When it comes to how much money you invest, this is going to depend on really your lifestyle. It's how much money do you make, and how much money do you spend, and how much margin is there that you can put towards your investments. If you're not happy with how much money you're making, then you can start by making more money. Does this mean getting a second job? Does this mean working harder at the job that you have now? Does this mean you're working for a promotion? Does this mean you're working for a raise or a bonus? Now you're working to earn more money with the purpose of investing more money, because the more you invest, the wealthier that you will become. If it's not from a job, can you create a side hustle? Can you start a business? Is there something else that you can do? Maybe you get a certificate, you look for a new career, you look for a new job, you do something that way you can earn more money, because now you're earning more money with the purpose of having more money to invest. Then on the flip side is also, can I spend less money? Are there places where you can cut back? Can you get rid of your car? Can you live a little bit smaller? Are there things that you don't need that you can sell, that you can get rid of? That way you have more cash now to invest. So you can earn more and you can spend less, which will create a bigger margin, meaning you have extra cash. But the question is, why are you having the extra cash now? Are you just going to keep this cash in the bank, or are you going to put this money to work? If you put this money to work, now you will have more money. So the key here now, if you want to see bigger success, well, you need more money to invest. The more money you invest, the wealthier you will become, period. And we just talked about how you can do that. You can earn more, you can spend less. I'm not going to go too deep into now how do you earn more, spend less in this video, but I have other videos on my channel where I discuss that. Now let's talk about the return, because this is what can now make or break your investments. And I want to start by talking about fees, because I kind of hinted at that when I was talking about the research, because fees can eat up your return. If we come back to this example here, where you turn your $100 a month investment to $1 million, but this time now you're putting your money into an investment that gives you a 1% fee. So you're getting the same return, but then you have a 1% fee. Well, this 1% fee isn't going to eat up 1% of your investment portfolio. It isn't even going to eat up 10% of your investment portfolio. It isn't even going to eat up 20% of your investment portfolio. If you have a 1% fee, you're not going to end up with $1 million. You're going to end up with right around $750,000, because a small little 1% fee isn't just a 1% fee you pay once. It's a 1% fee you pay on every dollar that you invest, which means you have less money invested. And then every dollar that your dollar grows to each and every year. So now you're compounding your money, but you're also compounding your fees over the entire course of your investment. Now again, this doesn't mean that these fees are never worth it. There are some places where these fees will be worth it, assuming that now you can justify the fee with higher returns. But you're going to need much higher returns to justify even just a 1% fee, because that 1% fee can really eat up the value of your investment portfolio over time. And if now you can't get a 10% return, but you get a 7% annual return, well, now the years are a little bit different. If you're still investing the $100 a month, now it's going to take you 60 years to hit the $1 million. If you're investing the $300 a month, now it's going to take you 44 years to hit that $1 million mark. And if you can invest $1,000 a month, now it'll take you 28 years to hit that $1 million mark. Again, it's very accessible. The more money you invest, the more wealth you will achieve. But this is where understanding that these types of returns are achievable, and you can get better returns the more research you do. But this is where you got to pay attention to the fee and what you're investing in. But you have to be willing to do the research. You have to be willing to fund it. And then you got to do number 3, which is automate it. The way you can actually succeed as this type of passive investor is you want this to be as passive and automatic as possible, meaning every week or every 2 weeks or every month, you pick your own interval, but every so often, money is automatically going to be invested, and this does not change. It doesn't matter if the market's up or down. You do this for a number of years, if not decades. That way you can actually build wealth, because you need the time, but you have to have it be passive, and that means you want it to be automatic because you don't want it to rely on you. Now, there's a lot of brokerages out there that will automate this process for you. Personally, I use something called M1 Finance. I have been sponsored by M1 Finance in the past. They are an affiliate for Minority Mindset, meaning if you use any of my affiliate links for them, we will get compensated, but I want you to do your own due diligence because it's just what I like. I want you to find the best app for you. Now, if you want to learn more about M1 Finance, I have my affiliate link down in the description, but the reason why I like M1 Finance for this type of passive investing it's because all they do is passive investing. They do it without fees. And on top of that, it's super simple to use. So for me, the way that I do it, and again, create your own strategy. For me, this is just how I do it. For me, every Wednesday, I have cash that leaves my checking account and is automatically invested into my portfolio of ETFs. The reason why I do Wednesday is not any sort of secret sauce or anything. I used to do Monday or Friday, but the problem was that was when the federal holidays would fall. And so there was a number of weeks where I just wouldn't get any money invested because there would be a federal holiday. So I decided to put it in the middle of the week. That way the federal holidays don't really affect my investing schedule because I want to keep investing as often as possible. For me, I like it every week just because it's more often. So I get a better dollar cost average because of that, but you can pick your own strategy for you. So for me, I have it set up so every Wednesday, cash leaves my checking account and it is automatically invested into my portfolio of ETFs. I don't have to check it. I don't have to touch it. I don't have to do anything. It is on autopilot. So now it happens and I don't have to worry about it. For me, it's completely automatic, it's completely passive, and it's a tool that is working to now build me wealth on the side in addition to everything else that I'm doing. I have my active investment portfolio as well. where now I have my stocks in a different brokerage, where now I'm looking for companies to invest in. I'm looking for individual companies that I believe are good valued for me to invest in, but that is my active investments. It's more risky, more time intensive. My passive investments in the stock market are on autopilot, and now when I get my cash flow from my passive investments, it's automatically invested. So it's working to buy me more cash flow. So every week I'm putting more money into it. Some of these investments are paying me with cash flow. When I get this cash flow, it's buying me even more cash flow investments. So it's like a machine working to buy me assets, and these assets are buying me more assets themselves. The key here for you is you don't want to turn this off because people get scared. Oh, the market's going down, so I should sell out of this. Or I should change my strategy because of what's happening outside. Once you pick the ETFs that you want, you're done on your end. Now you set it up and forget it. You don't have to touch it because now the ETF should be working to pick the investments, to pick the assets, and you just have to keep funding it. The only time you would change it is if something's wrong with the investment institution that your ETF is with, or if something is wrong with the ETFs that you invested in. If you feel like you shouldn't have invested in those ETFs and you want to change it because of that, that would be the reasons why you change it. You shouldn't be changing or selling out of your ETFs just because we're going through an economic slowdown. Economic slowdowns, recessions, and market crashes happen. They have happened pretty much every decade now. So you should expect them to continue to happen, and those are just opportunities if you change anything to buy more, and that's it. You shouldn't be changing your strategy besides that. So if you want to be a millionaire stock market investor, you don't have to go out and try to find the next Amazon stock. Instead, you can find the right funds to invest in. These are ETFs, mutual funds, or index funds. And of course, when you're doing this, you want to make sure you research the funds, see what they're investing in, and make sure that aligns with their investment goals and your time horizon. Now, you find the right funds that you want to invest in. The next thing you want to do is set up a system where you're funding these ETFs, and you want to also pay attention to the fees, pay attention to the yield, pay attention to the numbers, make sure that it aligns with your goals. Then you have to automate the system. The way that you win and actually become a millionaire stock market investor is by investing for the long term. You set up an automatic system that was completely passive, and it keeps happening no matter what, and you don't change your strategy just based off of what's happening in the economy. Danger zone. And if you are in that financial danger zone, you should not have the comfort or luxury of sitting there watching Netflix when you are paying 25% a year to the credit card company. Because that 25% a year that you're paying to the credit card company is making them rich at your expense, and I want you to make yourself rich instead of them rich. But in order for you to make yourself rich, you gotta